Welcome to Finance for Sleep. I am Simon Grant, and it is a pleasure to have you here tonight. This channel exists to do something that very few financial resources attempt. To take the complex, often pressured world of money, and make it quiet. We believe that the language of finance, delivered without urgency, without alarm, without the need for your full and active attention, can become something surprisingly restful. A steady stream of information that asks nothing of you except that you let it pass through. Finance for Sleep is an alphabetical journey. We are working our way through the language of money, one letter at a time. We have already moved through A and B. Tonight, we begin C. C is a generous letter in the world of finance. It gives us capital and cash, clearing and credit, collateral and commodity. Over the course of 3 parts, we will move through 50 entries each, 150 words in total. Tonight is part 1. Words 1 through 50. Beginning, as the alphabet requires, at the beginning. Before we go any further, a brief but important reminder. This program is not intended to be listened to while driving or operating machinery. It is designed for rest. For the quiet hours. For the transition between the day and sleep. Nothing heard on this program should be taken as financial, legal, or investment advice. The definitions provided are for general educational purposes only. If you have not yet subscribed to the channel, we would be very glad to have you. We release a new letter regularly, and the library is growing, quietly, one entry at a time. Now, make yourself comfortable. There is no need to take notes. No need to memorize anything you hear. The terms we will cover tonight are entering the room gently. They will define themselves, offer a brief explanation, and then make way for the next. Tonight we will be covering financial words beginning with the letter C. From call options to collateralized debt obligations, each term will be defined, gently explored, and then set aside. Let the words settle around you like the details of a very organized, very unexciting document. There is no rush. And there is nothing else you need to do. Call option. A call option is a financial contract that gives the buyer the right, but not the obligation, to purchase an asset at a predetermined price within a specified period of time. Imagine a quiet room filled with filing cabinets. Each drawer contains a contract. Each contract describes an agreement made between 2 parties, an agreement written in careful, measured language, sealed and set aside to wait. The buyer of a call option pays a small fee called a premium. In exchange, they hold the right to buy something at a price that has already been agreed upon. Whether they exercise that right is entirely their own decision. The word option comes from the Latin optio, meaning choice. In finance, the choice belongs to the buyer alone. Call options are used by investors who believe the price of an asset will rise. They are also used by institutions to manage risk across large portfolios, creating layers of protection that are rarely noticed until they are needed. Callable bond. A callable bond is a type of bond that can be redeemed by the issuer before its scheduled maturity date, at a price specified in the bond's terms. Picture a long corridor lined with locked doors. Behind each door is a borrowing arrangement, a promise made between an institution and its creditors. Some of those doors have an extra mechanism. A second key held by the institution. A key that allows the door to be opened early. That is the nature of a callable bond. the issuer retains the right to return the borrowed capital ahead of schedule. Callable bonds typically offer a slightly higher interest rate than comparable non-callable bonds. This additional yield compensates the bondholder for the risk that the bond may be called away before they have fully benefited from the agreed terms. Issuers generally call bonds when interest rates have fallen, allowing them to refinance their debt at a lower cost. It is a quiet, administrative act, one that rearranges financial obligations with a minimum of ceremony. Cap rate. A cap rate, or capitalization rate, is a metric used in real estate to estimate the potential return on an investment property. It is calculated by dividing the property's net operating income by its current market value. Imagine a building standing at the edge of a quiet street. The lights in the windows suggest tenants. The tenants suggest rent. The rent, after expenses, suggests a number. That number, divided by the value of the building itself, produces the cap rate. A higher cap rate generally indicates a higher potential return, but also a higher level of risk. A lower cap rate suggests stability, a property in an established market, income that can be reasonably predicted from one year to the next. Real estate investors use cap rates to compare properties across different markets and asset classes. They allow for a standardized measure of income performance, a common language spoken quietly across the industry. Cap rates are not fixed. They shift with market conditions, interest rates, and investor sentiment, adjusting slowly, like the hands of a clock in a room where no one is watching. Capital. Capital refers to the financial assets, or the value of those assets, that an individual, company, or economy uses to fund operations, investments, or growth. In its broadest sense, capital is wealth put to work. Think of a still warehouse at the end of the day. The shelves are stocked. The machinery is idle. Everything present, the equipment, the inventory, the reserves held in account, represents capital in its various forms. It is the accumulated resource that makes future activity possible. Capital takes many forms. Physical capital includes buildings, tools, and equipment. Financial capital includes cash, securities, and credit. Human capital refers to the skills and knowledge held by a workforce. The word capital comes from the Latin caput, meaning head. In Roman times it referred to the principal sum of a loan, the head of a financial transaction, from which interest grew like branches. In modern economics, capital is considered one of the four primary factors of production, alongside land, labor, and entrepreneurship. It is the quiet engine behind nearly every economic transaction, present even when it is not visible. Capital adequacy. Capital adequacy refers to the sufficiency of a financial institution's capital relative to the risks it carries. It is a measure of whether a bank or other institution holds enough reserves to absorb potential losses without becoming insolvent. Picture a bank vault. Not the dramatic image of heavy steel and combination locks, but something quieter, a ledger of figures maintained in careful columns. One column lists assets. Another lists the risks attached to those assets. A third column asks whether enough has been set aside. Regulatory bodies around the world set minimum capital adequacy requirements. These are expressed as ratios, the ratio of a bank's capital to its risk-weighted assets. The most widely recognized standard comes from the Basel Accords, a series of international banking agreements developed over several decades. The Basel III framework, introduced following the global financial crisis, raised minimum capital requirements and introduced new liquidity standards. Banks must now hold higher quality capital, capital that can genuinely absorb losses when conditions deteriorate. Capital adequacy is not a number that changes dramatically from one day to the next. It is maintained steadily, reviewed regularly, and adjusted only when circumstances require it. It is, in many ways, one of the quieter corners of finance, vital, technical, and rarely discussed until it is tested. Capital allocation. Capital allocation is the process by which an organization decides how to deploy its financial resources across different investments, projects, or business units in order to generate the highest possible return. Imagine a long wooden table in an empty boardroom. Across the table lie several proposals. Each one represents an opportunity. Each opportunity requires funding. The question being answered, slowly, methodically, with considerable amounts of paperwork, is where the money should go. Effective capital allocation requires a clear understanding of risk, return, and strategic priorities. Resources directed toward high-return projects create value. Resources directed poorly erode it. At the corporate level, capital allocation decisions include whether to invest in new equipment, acquire another company, return cash to shareholders through dividends or buybacks, or pay down existing debt. Each decision carries consequences that may not become visible for years. Warren Buffett has described capital allocation as the most important skill a chief executive can possess. The reasoning is straightforward. Over time, the cumulative effect of these decisions determines the financial character of an organization. Capital expenditure. Capital expenditure, often abbreviated as CapEx, refers to the funds a company spends to acquire, maintain, or upgrade long-term physical assets such as property, plant, and equipment. Think of an empty construction site in the early morning. The ground has been broken. Materials have been delivered. Workers have not yet arrived. Everything that will eventually rise from that ground, the structure, the infrastructure, the finished facility, will be classified as capital expenditure. It is money spent not on the day's operations, but on the future. Capital expenditure is distinct from operating expenditure, which covers the day-to-day costs of running a business. CapEx is recorded on the balance sheet as an asset and then gradually expensed through depreciation over the useful life of the asset. High capital expenditure is common in industries such as manufacturing, telecommunications, energy, and transportation, industries that require significant physical infrastructure to function. Analysts often examine a company's capital expenditure relative to its depreciation. If a company is spending less on CapEx than it is depreciating its existing assets, it may be allowing its infrastructure to age without adequate reinvestment. It is a quiet signal, visible only to those who look carefully at the numbers. Capital flight. Capital flight refers to the large-scale movement of financial assets or capital out of a country, typically in response to political instability, economic uncertainty, currency risk, or unfavorable tax conditions. Imagine a river that has quietly changed course. For years it flowed through a particular valley. Then, slowly, almost imperceptibly, the water began to find another path. By the time anyone noticed, the original channel was already running dry. Capital flight follows a similar logic. When investors, corporations, or wealthy individuals perceive excessive risk within a country, they move their assets elsewhere. The capital does not disappear, it simply leaves. The consequences can be significant. A country experiencing capital flight may see its currency depreciate, its interest rates rise, and its government's ability to fund public services diminish. Foreign reserves can fall rapidly. Capital flight is difficult to prevent through ordinary means. Capital controls, restrictions on the movement of money across borders, have historically had limited effectiveness and can themselves signal the very instability that investors fear. The relationship between policy and capital movement is delicate and not always predictable. Capital gains. A capital gain is the profit realized when an asset is sold for more than its original purchase price. The gain is the difference between the sale price and the cost basis of the asset. Picture a ledger open on a desk in a quiet room. On the left side of the page, a purchase price recorded years ago. On the right side, a sale price recorded today. The space between those two numbers, the quiet margin that accumulated over time, is the capital gain. Capital gains can arise from the sale of shares, real estate, bonds, collectibles, or any other asset that has appreciated in value. They are generally only recognized for tax purposes at the moment of sale, not during the period of appreciation. In most jurisdictions, capital gains are subject to taxation. The rate applied often depends on how long the asset was held. Assets held for longer periods typically qualify for lower rates, a policy designed to encourage long-term investment over short-term speculation. Unrealized capital gains, the appreciation of assets that have not yet been sold, sit silently on balance sheets and in portfolios, present but uncounted, until the moment a transaction makes them real. Capital injection. A capital injection is the infusion of new funds into a company, bank, or financial system, typically to strengthen its balance sheet, improve liquidity, or prevent insolvency. Imagine a building whose foundations have begun to settle unevenly. Engineers are called. An assessment is made. What is required is not demolition, but reinforcement, additional material introduced carefully at the points of greatest stress. The building remains standing. Its structure is stabilized. A capital injection works in much the same way. When an institution's capital levels fall below what is necessary to continue operating safely, additional funds are introduced. These may come from existing shareholders, new investors, or, in cases of systemic importance, from government sources. Government capital injections into financial institutions became widely discussed during the global financial crisis of 2008. Several large banks received state support in the form of equity injections, allowing them to continue operating while their balance sheets were repaired. Capital injections are neither unusual nor inherently alarming. They are a standard tool of financial stabilization, applied quietly and methodically, one transaction at a time. Capital loss. A capital loss occurs when an asset is sold for less than its original purchase price. It is the inverse of a capital gain, a reduction in value realized at the point of sale. Think of a balance sheet entry made several years ago. A number recorded in a moment of optimism. The market has since moved. The asset is now worth less. When the sale is completed, the difference between what was paid and what was received becomes a capital loss, a figure that must be acknowledged and recorded. Capital losses have practical uses within a tax framework. In many jurisdictions, they can be used to offset capital gains, reducing the total taxable amount for the year. This process is sometimes referred to as tax loss harvesting. Capital losses that exceed capital gains in a given year may be carried forward into future tax years, providing an offset against future gains. The rules governing this treatment vary by jurisdiction and asset type. A capital loss does not represent failure in any absolute sense. Markets move in both directions, and losses are a natural and expected element of investing over time. They are recorded, accounted for, and, where possible, put to use. Capital markets. Capital markets are financial systems in which long-term debt and equity instruments are bought and sold. They include stock exchanges, bond markets, and other venues through which capital is raised and allocated across the economy. Picture a vast building, many floors high, filled with terminals and transaction records and the accumulated documentation of millions of decisions made over decades. Very little of what occurs there is visible from the outside. And yet, the capital markets represented within that building connect governments, corporations, and investors across the entire world. Capital markets serve two primary functions. In the primary market, new securities are issued and sold directly by the entities that create them, governments raising funds through bond issuances, companies raising equity through initial public offerings. In the secondary market, previously issued securities are traded between investors. The functioning of capital markets depends on transparency, regulation, and the consistent enforcement of rules. Price discovery, the process by which markets determine the value of an asset, requires that participants have access to reliable information. Capital markets operate continuously, across time zones, across asset classes, across languages. They are, in many respects, the circulatory system of the global economy, moving resources from where they are held to where they are needed. Capital outflow. Capital outflow refers to the movement of financial assets or money out of a country or economy, typically toward investments in foreign markets or assets. Imagine a landscape of slow, steady movement. Not dramatic, no rushing water, no visible current. Simply a persistent shift in the direction of resources, a reorientation of financial weight from one geography toward another. Capital outflows occur when domestic investors choose to place their funds abroad, when foreign investors withdraw their investments from a country, or when corporations transfer profits and reserves to overseas accounts. They are a normal feature of an interconnected global economy. However, when capital outflows become substantial or rapid, they can place pressure on a country's currency, reduce domestic investment, and constrain economic growth. Central banks and governments monitor capital flow data carefully as an indicator of economic confidence. The causes of capital outflow are varied. Higher returns available in foreign markets, concerns about domestic political or economic stability, unfavorable exchange rate movements can all prompt capital to move. The movement itself is rarely announced. It appears in the data afterward, quietly registered in the balance of payments. Capital preservation. Capital preservation is an investment strategy that prioritizes the protection of the original amount invested above all other considerations, including growth. The primary goal is to ensure that the investor does not lose their principal. Think of a sealed container set carefully on a high shelf. Whatever was placed inside, a sum of money, a store of value, is to remain intact. Not grown. Not transformed. Simply preserved, undisturbed, against the passage of time. Capital preservation strategies typically involve low-risk instruments such as government bonds, treasury bills, money market funds, and certificates of deposit. These instruments offer modest returns, but carry minimal risk of principal loss. Capital preservation is most relevant for investors who are close to a major financial milestone, such as retirement, or who require their funds to be available within a defined and near-term time frame. Growth can wait. The money cannot afford to diminish. The cost of capital preservation is opportunity cost, the returns that might have been earned had the funds been placed in higher risk, higher return investments. This trade-off is accepted deliberately, in exchange for certainty. Not all of finance is concerned with accumulation. Some of it is simply concerned with holding what is already there. Capital rationing. Capital rationing is the process of limiting the amount of new investment undertaken by a firm or individual, either due to constraints on available funds or as a deliberate management decision to prioritize certain projects over others. Imagine a garden in autumn. The gardener has seeds for many plants, far more than the garden can hold. A decision must be made about which seeds to plant, which to store for another season, and which to set aside entirely. The available space is the constraint. The selection process is capital rationing. In a business context, capital rationing occurs when a company has more potentially profitable investment opportunities than it has capital to fund. Management must then apply criteria, typically relating to expected returns, strategic alignment, and risk, to determine which projects proceed. There are two forms of capital rationing. Soft rationing is internally imposed, a management decision to limit investment to preserve flexibility or meet internal targets. Hard rationing is externally imposed, a genuine constraint on a firm's ability to raise additional capital from markets or lenders. The discipline imposed by capital rationing, while limiting in some respects, can improve the quality of investment decisions. When resources are finite, they tend to be directed with greater care. Capital reserve. A capital reserve is a portion of a company's equity that has been set aside and is not available for distribution to shareholders as dividends. It is typically funded from non-trading gains such as the revaluation of assets or the proceeds from issuing shares above their nominal value. Picture a quiet room at the back of a very orderly office. Inside it, kept in careful order, the non-distributable reserves, funds held not for immediate use, but for longer-term stability. They are available, but they are not for spending lightly. Capital reserves serve several purposes. They provide a financial cushion against unexpected losses. They can be used to fund capital projects. And they signal to creditors and investors that the company maintains a stable and prudent financial position. The rules governing capital reserves vary by jurisdiction. In many countries, specific regulatory requirements determine how much must be held and under what circumstances it may be used. Capital reserves are distinct from revenue reserves, which are generated from a company's trading profits and may be distributed to shareholders. The capital reserve is the quieter, more permanent part of the equity structure, present in the background, rarely disturbed. Capital structure. Capital structure refers to the way in which a company finances its overall operations and growth through a combination of equity and debt. It describes the proportions of different funding sources that make up a firm's total capital. Think of the foundations of a building. Some sections are built from one material, others from another. The combination of these materials, their proportions, their placement, their relationship to one another, determines how the structure bears weight and withstands pressure. Capital structure works in a similar way. A company's capital structure typically consists of equity, funds raised from shareholders, and debt, which includes bank loans and bonds. The ratio of debt to equity is known as leverage, or gearing. A highly leveraged company has financed a large proportion of its operations through borrowed money. The optimal capital structure balances the tax advantages of debt, since interest payments are often tax-deductible, against the risks that come with higher leverage. Too much debt increases financial fragility. Too little may mean the company is not making full use of available financing. Modigliani and Miller, two economists working in the 1950s, proposed that in a world without taxes or transaction costs, capital structure would be irrelevant. The real world, of course, contains both. And so the question of capital structure remains one of the quieter, more persistent puzzles of corporate finance. Capitalization. Capitalization, in finance, refers to the total market value of a company's outstanding shares of stock, also known as market capitalization. More broadly, it also refers to the process of recording a cost as an asset rather than an expense on a financial statement. Imagine a long list of numbers. Each number represents a share price multiplied by the total number of shares in existence. The result, the sum of all those quiet multiplications, is the market capitalization of a company. A single figure that attempts to express what the market believes a business is worth at any given moment. Market capitalization is commonly used to categorize companies by size. Large-cap companies typically have a market capitalization above $10 billion. Mid-cap companies fall between $2 and $10 billion. Small-cap companies fall below $2 billion. These classifications influence how companies are analyzed and how they are included in various indices and funds. In accounting, capitalization refers to the decision to record a cost as a long-term asset, to be expensed gradually over time through depreciation, rather than as an immediate expense. This treatment is applied to costs that will provide benefit over multiple accounting periods. Both uses of the word share a common thread, the transformation of a value into something that persists, a number, classification, a balance sheet entry that will be revisited again and again. Carry cost. Carry cost, also known as the cost of carry, refers to the total expense of holding an investment or financial position over a period of time. It includes interest charges, storage costs, insurance, and any other ongoing expenses associated with maintaining the position. Picture a warehouse at the edge of a cold and quiet city. Inside, goods are stored. The storage itself has a cost. The insurance protecting those goods has a cost. The financing used to acquire the goods has a cost. The sum of all these costs, accumulating quietly each day the goods remain in the warehouse, is the carry cost. In financial markets, carry cost most commonly refers to the cost of holding a leverage position. An investor who borrows funds to purchase securities must pay interest on those borrowings. This interest, along with any dividends foregone or other holding costs, constitutes the carry. In commodity markets, carry cost includes physical storage, insurance, and transportation. In currency markets, it reflects the interest rate differential between two currencies. A carry trade is a strategy in which an investor borrows in a low-interest rate currency and invests in a high-yielding one, seeking to profit from the difference. The carry cost in this context is the interest paid on the borrowed funds. The strategy is quiet in design, dependent on stability, and sensitive to sudden shifts in market conditions. Carry trade. A carry trade is an investment strategy in which an investor borrows funds in a currency or asset with a low interest rate and uses those funds to invest in a currency or asset with a higher interest rate, profiting from the difference. Think of two rivers moving at different speeds. One is slow and carries a modest current. The other moves with more energy. A carry trade is the act of drawing from the slower river and directing that flow into the faster one, collecting the difference in momentum as it passes through your hands. The classic carry trade involves currencies. An investor borrows in Japanese yen, historically a low-interest rate currency, and invests in Australian dollars or another high-yielding currency. If exchange rates remain stable, the investor profits from the interest rate differential without any active management of the position. The risk inherent in a carry trade lies in that stability assumption. If the exchange rate moves sharply against the investor, if the borrowed currency strengthens significantly, the trade can result in substantial losses that outweigh the interest income earned. Carry trades can be unwound rapidly when market conditions change. When many investors hold similar positions and exit simultaneously, the result can be significant volatility in the currencies involved. This unwinding happens quickly, but the trades themselves are built and held in silence, accumulating returns one quiet day at a time. Cash. Cash, in finance, refers to money in its most liquid form, physical currency and coins, as well as funds held in bank accounts that are immediately accessible. It is the most basic unit of financial value and the foundation upon which all other financial instruments are built. Imagine a single banknote resting on a flat surface in an empty room. It has no maturity date. It carries no interest. It requires no counterparty. It simply is, a stored unit of value, available at any moment, for any purpose. In accounting, cash is listed as the first item under current assets on a balance sheet. It is the most liquid asset a business can hold. Liquidity, the ease with which an asset can be converted into cash, is measured relative to cash itself. Cash flow, the movement of cash in and out of a business, is considered by many analysts to be a more reliable measure of financial health than profit. A company can report profits while simultaneously running out of cash. When the cash runs out, operations cannot continue regardless of what the accounts show. The management of cash, how much to hold, where to keep it, and how to deploy it, is one of the fundamental disciplines of corporate finance. Cash is patient. It earns little on its own. But it is always available when it is needed, and that availability carries a value that cannot be entirely measured. Cash accounting. Cash accounting is a method of bookkeeping in which revenues and expenses are recorded only when cash is actually received or paid, rather than when they are earned or incurred. Think of a shopkeeper at the end of a long day, counting the coins in the till. What went in during the day is income. What went out is expense. The count reflects only what actually changed hands. No credit extended to a customer has been counted as income yet. No invoice received but not yet paid has been counted as an expense. Only the cash that moved is recorded. Cash accounting is simple to understand and straightforward to maintain. It gives a clear picture of the actual cash position of a business at any given point in time. For this reason, it is commonly used by small businesses, sole traders, and individuals managing personal finances. However, cash accounting can obscure the underlying financial performance of a business. A company might receive a large payment in one period and incur significant expenses in another, creating a distorted picture of profitability. The alternative method, accrual accounting, records revenues and expenses when they are earned or incurred, regardless of when cash changes hands. Most large organizations are required to use accrual accounting under generally accepted accounting principles. Cash accounting remains the simpler choice where it is permitted, and for those who prefer their numbers to reflect only what has already arrived. Cash burn rate. Cash burn rate refers to the speed at which a company is spending its available cash reserves, typically expressed as the amount of cash consumed per month. It is most commonly discussed in relation to early-stage companies that are not yet generating revenue sufficient to cover their expenses. Picture a candle placed in a dark room. Its flame is steady. The wax beneath it is finite. The rate at which the candle burns determines how long the light will last. A company's cash burn rate works in precisely this way. It determines the length of time remaining before the available cash is exhausted. A company's cash burn rate is calculated by subtracting its total monthly cash outflows from its total monthly cash inflows. If the result is negative, the company is burning through its reserves. If the result is positive, the company is generating more cash than it spends. Closely related to burn rate is the concept of runway, the number of months a company can continue operating at its current rate of expenditure before its cash runs out. Investors and analysts examine runway carefully when evaluating early-stage businesses. Managing burn rate is a discipline of restraint. It requires an ongoing awareness of expenses, a careful assessment of what is essential and what can wait, and a clear understanding of how much time remains. In a quiet room with a single candle, that understanding is not optional. Cash conversion cycle. The cash conversion cycle is a financial metric that measures the time it takes for a company to convert its investments in inventory and other resources into cash flows from sales. It represents the number of days between paying for raw materials and receiving payment from customers. Imagine a slow, methodical process. Raw materials arrive at a factory. They are transformed. The finished goods are stored. A sale is made. An invoice is issued. The invoice is eventually paid. The cash arrives. The entire journey, from the first outflow to the final inflow, is what the cash conversion cycle measures. The cash conversion cycle is calculated by adding the number of days inventory is held to the number of days it takes to collect payment from customers, then subtracting the number of days the company takes to pay its own suppliers. A shorter cash conversion cycle is generally preferable. It means the company retrieves its invested cash more quickly, reducing the need for external financing. A longer cycle suggests that cash is tied up in the business for extended periods, which can create liquidity pressure. Some businesses achieve a negative cash conversion cycle. They collect payment from customers before they must pay their suppliers. In these cases, the business effectively operates using its customers' money, a quiet and efficient arrangement that is the envy of most industries. Cash dividend. A cash dividend is a payment made by a company to its shareholders, distributed directly in the form of money rather than additional shares or other assets. It represents a distribution of a portion of the company's earnings. Picture a long table set in a quiet room. Around the table sit shareholders, some present in person, most present only as entries in a register. A portion of the company's earnings has been set aside. A calculation has been made. A payment is issued, proportional to each shareholder's holding. Each receives their share in cash. Cash dividends are typically paid on a regular schedule, quarterly in many markets, annually in others. The amount is determined by the company's board of directors and reflects their assessment of how much of the current earnings can be distributed while still supporting the company's ongoing needs. A consistent history of cash dividend payments is often viewed as a signal of financial stability. Companies that pay regular dividends tend to be mature, profitable businesses with predictable earnings. Growth-focused companies, by contrast, often reinvest their earnings rather than distribute them. When a dividend is paid, the share price of a company typically falls by approximately the amount of the dividend. The value has been transferred from the company to the shareholder. What was held collectively is now held individually, in cash, ready to be used. Cash equivalents. Cash equivalents are short-term, highly liquid investments that can be readily converted into a known amount of cash and are subject to an insignificant risk of change in value. They are typically held for periods of 3 months or less. Think of a row of small, sealed envelopes. Each contains a precise amount. Each can be opened at a moment's notice. The funds inside are not tied up in anything unpredictable. They are simply waiting, liquid, stable, unavailable, as close to cash as it is possible to be without being cash itself. Common examples of cash equivalents include treasury bills, commercial paper, money market funds, and short-term government bonds. These instruments are characterized by their stability of value and their ease of conversion. On a balance sheet, cash equivalents are grouped together with cash under the heading of cash and cash equivalents. This combined figure is one of the first items analysts examine when assessing a company's short-term financial position. The distinction between cash and cash equivalents is, in practice, very slight. Both are available quickly. Both carry minimal risk. The difference lies in form. One is already cash, the other is something that will become cash, quietly and without complication, within a very short period of time. Cash flow. Cash flow refers to the movement of money into and out of a business, investment, or financial account over a specific period of time. Positive cash flow indicates that more money is coming in than going out. Negative cash flow indicates the reverse. Imagine water moving through a system of pipes. In some sections, the flow is strong and steady. In others, it slows or reverses. The total pattern of movement, where the water goes, how much arrives, how much departs, is the cash flow of the system. Remove the water and replace it with money, and the analogy holds almost exactly. Cash flow is divided into 3 categories on a company's cash flow statement. Operating cash flow reflects the cash generated or consumed by the company's core business activities. Investing cash flow captures expenditure on long-term assets and returns from investments. Financing cash flow records transactions involving debt, equity, and dividends. Many analysts regard operating cash flow as the most meaningful indicator of a business's financial health. A company can report accounting profit while simultaneously consuming cash, an unsustainable condition that often goes unnoticed until it becomes serious. Cash flow cannot be manufactured. It cannot be adjusted through accounting choices in the way that profit sometimes can. It simply reflects what arrived and what departed, a quiet, honest ledger of financial reality. Cash flow hedge. A cash flow hedge is a risk management strategy in which a financial instrument is used to protect against the variability of future cash flows that may be affected by changes in interest rates, exchange rates, or commodity prices. Think of a farmer who knows that in 6 months, a harvest will be ready to sell. The price of that harvest is uncertain. It will depend on market conditions that have not yet materialized. To protect against an unfavorable price movement, the farmer enters into an agreement to sell the harvest at a fixed price today. The harvest is the same. The risk of variability has been reduced. In financial terms, a cash flow hedge involves entering into a derivative contract, such as an interest rate swap, a currency forward, or a commodity futures contract, to offset the potential variability in anticipated future cash flows. For a company with variable rate debt, a cash flow hedge might involve converting those variable interest payments into fixed payments using an interest rate swap. The company then knows with certainty what its interest costs will be, regardless of how interest rates move. Cash flow hedges are documented carefully and assessed for effectiveness on an ongoing basis. The accounting treatment for qualifying hedges is specific and detailed. But the underlying purpose is straightforward: to replace uncertainty with predictability, one carefully structured agreement at a time. Cash flow statement. A cash flow statement is a financial report that summarizes the actual movements of cash and cash equivalents into and out of a company during a specific accounting period. It is one of the 3 primary financial statements, alongside the income statement and the balance sheet. Picture a carefully maintained record book. On each page, transactions are recorded not by when they were agreed upon, but by when the money actually moved. The result is a document that strips away estimation and accrual, leaving only the factual record of cash received and cash paid. The cash flow statement is divided into 3 sections. The operating activities section records cash flows related to the company's core business. The investing activities section records cash used for or received from long-term investments. The financing activities section records cash flows related to borrowing, repaying debt, and transactions with shareholders. The cash flow statement bridges the income statement and the balance sheet. It explains how the company moved from its opening cash position to its closing cash position, accounting for every material movement along the way. Auditors, analysts, and creditors pay particular attention to the cash flow statement because it is harder to manipulate than the income statement. The numbers it contains are grounded in transactions that actually occurred. It is a document of events, not projections, a record of what happened, stated plainly. Cash management. Cash management refers to the process of collecting, handling, and controlling a company's or individual's cash flows in order to maintain adequate liquidity, minimize risk, and optimize the use of available funds. Imagine a room where every door represents a different financial obligation. Some doors must be opened today. Others will need to be opened next week. Still others are months away. Cash management is the discipline of ensuring that when each door is opened, the funds required to pass through it are available, neither too much nor too little, but precisely enough. Effective cash management involves forecasting future cash needs, accelerating the collection of receivables, managing the timing of payables, and investing surplus cash in short-term instruments that generate a return without sacrificing liquidity. Large corporations employ treasury departments specifically dedicated to cash management. These teams monitor daily cash positions across multiple accounts and currencies, moving funds between entities and jurisdictions to ensure efficiency and compliance. For individuals, cash management refers to the discipline of maintaining enough liquidity for near-term needs while directing surplus funds towards savings or investment. The scale differs. The principle does not. In both cases, the goal is the same: to ensure that money is where it needs to be, when it needs to be there, without waste and without shortage. Cash position. A cash position refers to the amount of cash and cash equivalents that an entity, whether a company, an investment fund, or an individual, holds at any given point in time. It reflects the degree of liquidity available immediately. Think of the balance visible in an account at the close of a business day. The figure sits there, unambiguous. It is not an estimate. It is not a forecast. It is the actual amount that could be deployed, right now, without selling any other asset or entering into any new arrangement. That figure is the cash position. A strong cash position provides flexibility. It allows a company to meet unexpected obligations, pursue acquisition opportunities, or weather a period of reduced revenue without resorting to external financing. It is a buffer against uncertainty. A weak cash position, by contrast, can create vulnerability. A company with insufficient cash may be forced to sell assets at unfavorable prices, borrow on poor terms, or delay payments to creditors. These pressures compound over time. Investment funds also maintain cash positions, typically expressed as a percentage of total assets. A high cash position in a fund may reflect caution. The manager anticipates better buying opportunities in the future and is not yet fully invested. A low cash position reflects a high degree of commitment to existing holdings. Neither is inherently right or wrong. Both are deliberate. Cash reserve. A cash reserve is a portion of an entity's funds set aside specifically to meet unexpected expenses, emergencies, or short-term obligations. It is maintained separately from funds earmarked for investment or regular operational use. Picture a sealed drawer in a very organized desk. The desk has many other drawers, each labeled, each dedicated to a specific purpose. The sealed drawer is different. Its contents are not for routine use. They are held back, specifically, for moments when something unexpected arrives. For individuals, a cash reserve, often referred to as an emergency fund, typically represents 3 to 6 months of living expenses. For businesses, reserve requirements vary based on the nature of operations, the predictability of cash flows, and the degree of access to external credit. Banks are subject to regulatory requirements that specify minimum levels of cash reserves relative to deposits. These requirements exist to ensure that banks can meet customer withdrawal requests and absorb short-term liquidity stress. A cash reserve earns little on its own. Money held in reserve is not deployed in higher return investments. This is the accepted cost of having it, the return given up in exchange for the certainty that it will be there when it is needed. The reserve does not draw attention to itself. It simply waits. Cash surrender value. Cash surrender value is the amount of money an insurance policyholder receives if they choose to cancel a permanent life insurance policy before it matures or before a claim is made. It represents the savings component that has accumulated within the policy over time. Imagine a contract that has been held for many years, not by a corporation, but by an individual, carefully filed away and renewed each year. Inside that contract is not just insurance. There is also a growing store of value, accumulating quietly with each premium payment, set aside by the insurer in a separate account. If the contract is ended early, that stored value is returned. Not all life insurance policies have a cash surrender value. Term life insurance, which covers a fixed period, does not. Permanent life insurance products, including whole life and universal life policies, typically do, because they are designed to accumulate a cash component alongside the insurance protection they provide. The cash surrender value of a policy grows over time as premiums are paid and as interest or investment returns are credited to the account. However, it may be reduced by fees, outstanding loans against the policy, or surrender charges, penalties applied during the early years of a policy for early termination. Policyholders can also borrow against the cash surrender value without cancelling the policy. The loan accrues interest, and any outstanding balance reduces the death benefit payable to beneficiaries. It is a flexible feature, though one that is rarely exercised in haste. Central bank. A central bank is a national financial institution responsible for managing a country's monetary policy, regulating its currency, overseeing its banking system, and acting as a lender of last resort to financial institutions in times of stress. Think of a very large, very quiet building near the center of a capital city. Its presence is understated. Its functions are rarely visible. But within its walls, decisions are made that affect the price of every loan, the value of every banknote, and the stability of the entire financial system. Central banks control the money supply through a range of tools, most prominently, the setting of benchmark interest rates. By raising or lowering the cost of borrowing, a central bank can influence inflation, employment, and economic growth. The decisions made in central bank meetings are among the most closely watched events in global finance. Well-known central banks include the United States Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, and the People's Bank of China. Each operates with a mandate that may include price stability, full employment, or financial system oversight, depending on the jurisdiction. Central banks are designed to be independent from short-term political pressure. This independence is considered essential to their credibility. A central bank that acts in the interest of long-term stability, rather than short-term popularity, must sometimes make decisions that are uncomfortable. It makes them anyway, quietly, and documents each one with considerable precision. Certificate of deposit. A certificate of deposit, commonly abbreviated as CD, is a savings instrument issued by a bank or credit union that pays a fixed interest rate over a specified term, in exchange for the depositor's agreement to leave the funds untouched for the duration of that term. Picture a small document, a single page, printed in modest type, confirming that a specific sum of money has been placed with a financial institution for a defined period of time. The institution promises to return that sum, plus interest, at the end of the term. The depositor promises not to withdraw it early. Certificates of deposit offer higher interest rates than standard savings accounts, because the depositor surrenders flexibility. The bank knows exactly how long the funds will be available to it, and compensates for that certainty accordingly. Terms for certificates of deposit range from a few weeks to several years. Longer terms typically carry higher rates. Early withdrawal generally incurs a penalty which can offset some or all of the interest earned. Certificates of deposit are considered among the safest financial instruments available. In most countries, deposits are insured up to a specified limit by a government-backed deposit insurance scheme. They are unremarkable instruments, steady, predictable, and exactly what they appear to be. In a world of complex financial products, there is something straightforwardly restful about that. Charitable Remainder Trust. A charitable remainder trust is a legal arrangement in which an individual transfers assets to a trust, which then provides the individual or designated beneficiaries with a regular income stream for a specified period, after which the remaining assets are distributed to one or more charitable organizations. Imagine a document drawn up in a quiet solicitor's office. It describes a transfer of assets, property, investments, or cash, into a structure that will hold them carefully for years. During that time, the income generated will flow to the individual who made the transfer. When the time comes, what remains passes on, not to family or estate, but to a cause the individual chose. Charitable remainder trusts offer a combination of philanthropic intent and financial planning. Contributions to the trust may qualify for a partial charitable deduction in the year of transfer. The trust itself is typically exempt from capital gains tax, allowing appreciated assets to be sold within the trust without immediate tax consequences. There are two primary forms. A charitable remainder annuity trust pays a fixed amount each year. A charitable remainder unit trust pays a percentage of the trust's value, which is recalculated annually and fluctuates with market conditions. These arrangements require careful legal and financial planning. They are not made impulsively. They are made by individuals who have thought at length about what they wish to leave behind, and how they wish to structure the time between now and then. Churning. Churning is the unethical practice by which a broker or financial advisor excessively trades a client's account in order to generate commission fees, without regard for the client's investment objectives or best interests. Picture a dial that spins constantly, not because the mechanism requires it, but because someone else is turning it. The motion creates the appearance of activity. Behind that motion, resources are being consumed, commissions paid, tax events triggered, returns eroded, without any corresponding benefit to the person whose account it is. Churning is prohibited under the regulatory frameworks governing financial services in most jurisdictions. Brokers and advisors are required to act in the best interests of their clients and must have a reasonable basis for each transaction they execute. Identifying churning can be difficult. Frequent trading is not automatically churning. Some investment strategies legitimately require active management. The test is whether the level of trading is consistent with the client's stated objectives and risk profile, and whether the advisor stood to gain from each transaction at the client's expense. Clients who suspect churning may file a complaint with the relevant regulatory authority or seek arbitration. In many jurisdictions, successful claims can result in the recovery of commissions paid and damages for investment losses. The practice is uncommon among reputable firms, but it exists, and its existence is the reason that trust, in finance, is always paired with oversight. Circuit breaker. A circuit breaker, in financial markets, is a regulatory mechanism designed to temporarily halt trading when prices fall or rise beyond a specified threshold within a given period. It is intended to prevent panic-driven volatility from escalating uncontrollably. Think of a fuse box in a quiet building. When a surge occurs, when the current suddenly exceeds what the system can safely carry, the fuse trips. The flow of electricity is interrupted. The surge is contained. The system is given a moment to stabilize before power is restored. In financial markets, circuit breakers operate in the same way. When prices decline sharply within a short period, typically by a specified percentage such as 7, 13, or 20%, trading is paused. Market participants are given time to absorb information, reassess positions, and act with greater deliberation. Circuit breakers were introduced in the United States following the stock market crash of October 1987, when the Dow Jones Industrial Average fell by over 22% in a single day. The pause mechanism was designed to prevent the kind of cascade that had made that decline so severe. Circuit breakers do not prevent market declines. They slow them. They introduce friction into a system that can otherwise move faster than human judgment can follow. For a few minutes, or a few hours, the market is required to stop, breathe, and reconsider. Claim. In finance and insurance, claim is a formal request made by a policyholder or beneficiary to an insurance company for compensation or coverage of a loss or event specified in a policy. More broadly, a claim can refer to any formal assertion of a right to something of financial value. Imagine a form completed at a desk. The handwriting is careful. The details are recorded in the spaces provided. The form is submitted. It enters a process, a review, an assessment, determination, that will eventually result in either a payment or a denial. That form, and the request it contains, is a claim. In insurance, claims may arise from many circumstances: property damage, medical treatment, disability, or death. The claim is the mechanism through which the promise made in the policy is put to use. Without the ability to make a claim, the insurance contract would offer nothing. In law and finance more broadly, a claim refers to a legal right to money or property. Creditors hold claims against borrowers. Shareholders hold claims against the assets of a company. The order in which these claims are satisfied, in the event of insolvency, for example, is determined by law and by contract. Claims are assessed according to the terms agreed in advance. The process is administrative, thorough, and sometimes slow. It proceeds at its own pace, without drama, toward a conclusion that was always contemplated, even if no one hoped it would be necessary. Clearing account. A clearing account is a temporary account used to hold funds in transit between two financial transactions. It is used to record amounts that are awaiting final allocation, reconciliation, or transfer to a permanent account. Think of an antechamber, a room between two larger spaces. Documents arrive from one direction, wait for a moment in this intermediate space, and then pass through to their final destination. The antechamber does not hold anything permanently. It simply receives and passes on. In accounting, clearing accounts are used to match incoming and outgoing transactions, particularly in situations where large volumes of transactions must be reconciled before final posting. Payroll clearing accounts, for example, receive the total payroll amount and then distribute individual payments to employee accounts. In banking and securities, clearing accounts hold funds between the execution of a trade and its settlement, the period during which ownership is formally transferred and payment is confirmed. This interim period, typically 2 business days for equity transactions, is bridged by the clearing account. Clearing accounts are by nature temporary. If amounts remain in a clearing account for an extended period without being allocated, it typically indicates an error or an unresolved discrepancy that requires investigation. The clearing account is not a destination, it is a passage, precise and purposeful, designed to keep money moving in an orderly direction. Clearing corporation. A clearing corporation, also known as a clearing house, is a financial institution that acts as an intermediary between buyers and sellers in financial markets, ensuring the completion of transactions by guaranteeing the obligations of both parties. Picture a very organized office operating behind the scenes of every financial exchange. When a trade is agreed between a buyer and a seller, the clearing corporation steps in between them. It becomes the buyer to the seller and the seller to the buyer. If either party fails to fulfill their obligation, the clearing house absorbs the impact and ensures the transaction is completed nonetheless. By standing between the 2 parties to a trade, the clearing corporation significantly reduces counterparty risk, the risk that the other party in a transaction will fail to meet their obligations. This function is essential to the stability of financial markets. Clearing corporations are heavily regulated and required to maintain substantial financial reserves. They employ sophisticated risk management systems to monitor the positions of their members and collect margin, collateral, to cover potential losses. Well-known clearing corporations include the Depository Trust and Clearing Corporation in the United States and LCH in Europe. Their work is rarely visible in ordinary market commentary, but it underpins every transaction that takes place. Markets function because clearing houses ensure that when a trade is struck, it will be settled. Clearing fee. A clearing fee is the charge levied by a clearing house or clearing corporation for processing and settling financial transactions. It is a cost associated with the administrative and risk management services provided during the clearing process. Imagine a toll on a very well-maintained road. The road does not advertise itself. It simply functions, reliably, in the background of every journey. The toll is paid, processed, and recorded without ceremony. The journey continues. The clearing fee operates in much the same way, present in every transaction, rarely noticed, consistently collected. Clearing fees are paid by the members of a clearing house, typically brokers, dealers, and financial institutions who participate in markets on behalf of their clients. These fees are often passed on to the end investor as part of the total cost of a transaction. The amount of a clearing fee depends on the type of transaction, the volume of trades processed, and the policies of the specific clearing house. Fees for exchange-traded derivatives differ from those for equity transactions. Fees for large institutional trades differ from those for retail orders. Clearing fees contribute to the financial stability of the clearing corporation. They fund the operational infrastructure, the risk management systems, and the reserves that allow the clearing house to guarantee settlement even under stress. The fee is not incidental. It is the price of certainty. Clearing house. A clearing house is a financial institution that facilitates the exchange of payments, securities, or derivatives between trading counterparties. It acts as the central intermediary in financial transactions, reducing the risk of default by either party and ensuring orderly settlement. Think of a large, quiet sorting facility. Thousands of transactions arrive each day: buy orders, sell orders, payment instructions, settlement requirements. The clearing house receives them all, matches them, verifies them, and ensures that each one is completed in the correct sequence and at the correct time. Clearing houses have existed since the 18th century, when London banks began meeting each day to exchange checks and settle net balances. The modern clearing house performs the same essential function, but across vastly more complex instruments and vastly greater volumes. In securities markets, clearing houses ensure that trades are settled, that buyers receive the securities they purchased and sellers receive the funds they are owed, typically within 2 business days. In derivatives markets, they manage the daily margining and risk monitoring of outstanding positions. Central clearing has become a cornerstone of post-crisis financial regulation. Following the 2008 global financial crisis, regulators around the world mandated that many classes of derivatives, previously traded bilaterally, between individual counterparties, be centrally cleared. The purpose was to reduce systemic risk and increase transparency. The clearing house, old in concept and continuously evolving in practice, is now more central to global finance than at any previous point in its history. Clearing member. A clearing member is a financial institution, typically a bank, broker-dealer, or investment firm, that has been approved to participate directly in the clearing process of a clearing house. Clearing members access the clearing house on their own behalf and on behalf of their clients. Imagine a gate that provides access to a very carefully managed system. Not everyone may pass through that gate. Only those who have met specific financial, operational, and regulatory requirements are granted entry. Those who have met those requirements and been admitted are the clearing members. Clearing members bear significant responsibilities. They are required to post margin, collateral, to cover their own positions and those of their clients. They are subject to ongoing capital and reporting requirements. And in some clearing structures, they may share in the responsibility of covering losses if another clearing member defaults. In return for these obligations, clearing members gain direct access to the clearing house's services, including the counterparty guarantee that the clearing house provides. This access is valuable. It allows them to offer settlement certainty to their clients and to participate directly in the markets they serve. Not all market participants are clearing members. Many trade through the services of an existing member, referred to as a general clearing member, who accepts responsibility for their trades. The distinction is one of access and obligation, and of the infrastructure required to meet both. Closed-end fund. A closed-end fund is a type of investment fund that raises a fixed amount of capital through an initial public offering and then lists its shares on a stock exchange. Unlike open-end mutual funds, it does not continuously issue or redeem shares based on investor demand. Picture a collection of assets held within a clearly defined container. The container is sealed after the initial offering. What is inside does not change in response to investor purchases or redemptions. Instead, investors who wish to buy into or exit the fund do so by trading its shares on the open market with other investors. Because closed-end fund shares trade on an exchange, their market price is determined by supply and demand, and may differ from the underlying net asset value of the fund's holdings. When the share price is below the net asset value, the fund is said to be trading at a discount. When above, it trades at a premium. Closed-end funds can hold a wide range of assets, including equities, bonds, real estate, and less liquid instruments that might be difficult to manage within an open-end structure. The fixed capital base allows fund managers to invest in longer-term, less liquid opportunities without needing to maintain cash for redemptions. The closed-end structure has existed for over a century. It is quieter in its mechanics than many modern investment vehicles, less responsive to the daily movements of investor sentiment, more committed to the portfolio it was assembled to hold. Closing costs. Closing costs are the fees and expenses paid at the completion of a real estate transaction, beyond the purchase price of the property itself. They are incurred by both buyers and sellers and are typically settled at the closing of the sale. Imagine a long table in a solicitor's or notary's office. Documents have been prepared. Signatures will be required. And alongside those signatures, a series of payments, some expected, some only recently calculated, must be settled before the keys can be transferred. These payments are the closing costs. Closing costs may include loan origination fees, appraisal costs, title insurance, legal fees, survey costs, property transfer taxes, and prepaid items such as homeowners insurance and property taxes. Their total can represent a significant amount, typically between 2 and 5% of the purchase price, though this varies considerably by location and transaction type. Buyers and sellers negotiate over who bears which closing costs. In some markets, sellers customarily cover certain expenses. In others, the allocation is different. Much depends on local convention and the dynamics of the specific transaction. Closing costs are often overlooked in the initial financial planning of a property purchase. They arrive at the end of the process, when the excitement of the transaction is at its peak, and they are due immediately. Knowing they are coming, and having set aside funds to meet them, makes the closing itself a quieter and more manageable occasion. Collateral. Collateral is an asset pledged by a borrower to a lender as security for a loan. If the borrower fails to repay the debt, the lender has the legal right to seize the collateral and sell it to recover the outstanding amount. Think of a key placed carefully on a desk across from a lender. The key belongs to something of value, a property, a vehicle, a portfolio of securities. The borrower places the key on the desk not to give it away, but as a guarantee. As long as the loan is repaid according to its terms, the key will be returned. If it is not, the lender is entitled to use it. Collateral reduces the risk for the lender. Because the borrower has something to lose, there is additional incentive to meet the repayment obligations. This reduced risk is often reflected in lower interest rates for secured loans compared to unsecured ones. Common forms of collateral include real estate, used in mortgages, vehicles, machinery, accounts receivable, financial securities, and inventory. The type of collateral accepted depends on the nature of the loan and the policies of the lender. The value of collateral is not fixed. It must be assessed at the time of the loan and may be subject to ongoing monitoring. If the value declines significantly, lenders may request additional collateral or restructure the loan. The relationship between collateral and credit is one of the quietest and most fundamental arrangements in finance, built on trust, formalized in contract, and protected by law. Collateral agreement. A collateral agreement is a legal contract that specifies the terms under which one party will provide assets as security to another, typically in the context of a financial transaction or lending arrangement. It outlines what assets qualify as collateral, how their value will be assessed, and what happens in the event of default. Imagine a very precise document, perhaps many pages long, describing an arrangement between two institutions. Every detail is covered. Which assets may be posted? In what form? When they must be delivered? How their value will be calculated? What triggers a requirement for additional collateral? And what rights the receiving party holds if the terms are not met? Collateral agreements are standard components of over-the-counter derivative transactions, securities lending arrangements, and repurchase agreements. In these markets, collateral changes hands regularly as the value of underlying positions fluctuates. The International Swaps and Derivatives Association has developed standardized collateral agreements widely used in derivatives markets. These agreements, known as credit support annexes, provide a common framework that reduces legal uncertainty and operational complexity. A collateral agreement is, at its core, a document of contingency. It describes an arrangement that both parties hope will never need to be enforced. But it is prepared in full, in precise detail, because in finance, the scenarios you document are the ones you are prepared for, and preparation is the quietest form of confidence. Collateral management. Collateral management refers to the process by which financial institutions administer the collateral posted and received in connection with financial transactions, including monitoring values, managing calls for additional collateral, and reconciling positions. Picture a very carefully organized inventory system. On one side, a list of assets held as security from counterparties. On the other, a list of assets posted as security to counterparties. Every day, the values of those assets are assessed. Where values have changed, adjustments must be made. Additional collateral must be requested, or returned, or substituted. This continuous process of monitoring and adjustment is collateral management. As financial markets have grown more complex and interconnected, collateral management has become an increasingly important function within banks and other financial institutions. The volume of collateral exchange daily, across thousands of counterparty relationships and multiple currencies and asset classes, is enormous. Effective collateral management requires sophisticated systems, clear legal agreements, and disciplined operational processes. It also requires the ability to optimize, to use the most efficient and cost-effective assets as collateral, directing higher quality assets only where they are specifically required. The importance of collateral management became particularly apparent during the 2008 financial crisis, when the failure to properly assess and manage collateral contributed to systemic instability. In the years since, regulatory reform has significantly increased both the volume of collateral required in financial markets and the attention paid to managing it well. Collateral pool. A collateral pool is a collection of assets grouped together to serve as security for a financial obligation, such as a bond issuance or a securitization. Rather than a single asset backing a single loan, a pool of assets collectively supports a larger financial instrument. Think of many small streams converging into a single body of water. Each stream contributes to the whole. Taken together, they create something larger and more stable than any individual stream could provide, a reservoir from which obligations can be met, and from which investors can draw confidence. Collateral pools are commonly used in mortgage-backed securities, asset-backed securities, and covered bond structures. In a mortgage-backed security, for example, thousands of individual home loans are grouped into a pool. The cash flows generated by those mortgages, the interest and principal payments made by homeowners each month, pass through the pool and are distributed to investors. The composition of a collateral pool matters significantly. Pools containing high-quality, well-diversified assets are considered more secure than those concentrated in a single type of asset or geography. Rating agencies assess collateral pools in detail before assigning credit ratings to instruments backed by them. A collateral pool does not change dramatically from day to day. It simply holds a collection of obligations and assets, carefully assembled and then maintained over time, generating the quiet, regular flows of cash that give the instrument above it its value. Collateralized debt obligation. A collateralized debt obligation, commonly known as a CDO, is a structured financial instrument that pools together various debt obligations, such as loans, bonds, or mortgages, and issues securities backed by that pool, divided into tranches of varying risk and return. Picture a large container filled with many different types of debt. Mortgages, corporate loans, other asset-backed securities. The container is then divided into sections, tranches, arranged in order of priority. The most senior tranche receives payments first and absorbs losses last. The most junior tranche receives payments last and absorbs losses first. Investors choose which section to buy based on their appetite for risk and return. CDOs were developed in the 1980s and grew rapidly in the early 2000s. They allowed banks to move loans off their balance sheets, creating room for additional lending. They also allowed investors to gain exposure to diversified pools of credit risk in customizable forms. The role of CDOs in the 2008 financial crisis is well documented. Many CDOs issued in the years prior to the crisis contained large concentrations of subprime mortgage loans. When those loans began to default at rates far higher than models had predicted, the losses spread through the tranches rapidly, affecting even instruments that had been rated as highly safe. The CDO remains a part of financial markets, though in a more cautious and regulated form. It is a complex instrument, intricate in structure, far-reaching in its effects, and one that carries, for those who study it, a number of very important lessons. Commercial bank. A commercial bank is a financial institution that accepts deposits from the public, provides loans to individuals and businesses, and offers a range of financial services such as current accounts, savings accounts, and payment processing. Picture a building on a main street in a mid-sized city. Its facade is modest. Its hours are posted by the door. Inside, transactions take place in an orderly queue. Money is deposited. Money is lent. Statements are printed and filed away. The commercial bank is, in many respects, the most familiar institution in finance, the one most people encounter first and most often. Commercial banks earn their revenue primarily through the difference between the interest they charge on loans and the interest they pay on deposits. This margin, known as the net interest margin, is the core of the commercial banking business model. Commercial banks are distinct from investment banks, which focus on capital markets activity, and from central banks, which are government institutions responsible for monetary policy. The commercial bank serves the everyday financial needs of households, small businesses, and larger corporations alike. Commercial banks are regulated by government authorities and are typically required to hold a specified proportion of their deposits in reserve. This requirement ensures that banks can meet the withdrawal needs of their customers, even during periods of financial stress. Commercial credit. Commercial credit refers to the credit extended by financial institutions or suppliers to businesses, allowing them to borrow funds or purchase goods and services on agreed payment terms rather than paying immediately. Think of an arrangement made between two businesses, one that supplies goods, one that receives them. The supplier delivers the order. The receiving company does not pay immediately. Instead, an invoice is issued, with payment due in 30, 60, or 90 days. That agreement, that extension of trust in exchange for a future payment, is commercial credit in one of its most common forms. Commercial credit encompasses a wide range of financial arrangements, including bank loans, lines of credit, trade credit, and letters of credit. Each serves a different purpose, but all allow businesses to operate and expand without requiring immediate cash for every transaction. Access to commercial credit is considered a key indicator of a business's financial health and reputation. A company that can obtain credit on favorable terms demonstrates that lenders and suppliers trust its ability to repay. A company that struggles to obtain credit may face significant operational constraints. The availability of commercial credit across an economy also reflects broader economic conditions. During periods of financial stress, credit conditions tighten. Lenders become more cautious. The quiet circulation of commercial credit slows, and with it, the pace of business activity. Commercial lending. Commercial lending refers to the practice of financial institutions providing loans to businesses, rather than to individual consumers. These loans are used to fund operations, purchase equipment, acquire real estate, or support growth and expansion. Imagine a meeting between a business owner and a banker, a quiet room, a table with documents, numbers presented and questioned and clarified. The business has a need. The bank has capital. The discussion is methodical. What is the purpose of the loan? What assets can secure it? What are the projected cash flows? What are the repayment terms? Commercial lending begins in moments like this one. Commercial loans take many forms. Term loans provide a fixed amount repaid over a defined period. Revolving credit facilities allow businesses to borrow, repay, and borrow again up to a set limit. Commercial mortgages finance the purchase of business property. Equipment financing is secured against specific assets. Commercial lending decisions are based on a careful assessment of the borrower's creditworthiness, their financial history, current performance, projected revenues, and the quality of any collateral offered. The decision is not made quickly. It is made carefully, with considerable documentation. The relationship between a business and its commercial lender is often long-term. Trust is built over time, through consistent repayment and open communication. When that trust is established, the terms of lending tend to improve. It is one of the quieter rewards of financial reliability. Commercial mortgage. A commercial mortgage is a loan secured against a commercial property, such as an office building, retail premises, industrial unit, or apartment complex, used to finance the purchase or refinancing of that property. Picture a large building standing on a corner. Its windows reflect the sky. Inside, tenants occupy the floors. The building was not purchased with cash alone. A lender contributed a significant portion of the purchase price in exchange for a legal charge over the property itself. That arrangement is a commercial mortgage. Commercial mortgages differ from residential mortgages in several important ways. The loan amounts are typically larger. The terms of lending are more complex and more negotiable. The assessment of creditworthiness focuses heavily on the income-generating capacity of the property, its rental income, its occupancy rate, and the strength of its tenants. Lenders will typically lend up to a certain percentage of the property's value, known as the loan-to-value ratio. A property worth $10 million might support a commercial mortgage of up to 65 or 70% of that value, depending on the lender's policies and the property's characteristics. Commercial mortgages are repaid over periods ranging from 5 to 25 years, though many include balloon payments, large lump sums due at the end of the term, requiring the borrower to refinance or sell the property at that point. The building stands. The mortgage persists beneath it, quiet and secured, until the final payment is made. Commercial paper. Commercial paper is a short-term, unsecured debt instrument issued by large corporations to raise funds for immediate operational needs such as payroll, inventory, and other short-term liabilities. It typically matures within a few days to a maximum of 270 days. Think of a promissory note, a simple, formal acknowledgement that a sum has been borrowed and will be returned within a short and specified period. The note does not offer collateral. It relies instead on the creditworthiness of the issuer. A company of sufficient size and reputation can issue such a note, and the market will accept it. Commercial paper is typically issued at a discount to its face value and redeemed at face value upon maturity. The difference between the two prices represents the interest earned by the investor. Because the terms are short and the issuers are generally large, well-rated corporations, commercial paper is considered a relatively low-risk instrument. Commercial paper markets are large and active, particularly in the United States. Money market funds are significant purchasers of commercial paper, as it provides a short-term, liquid instrument with a modest return above what government securities offer. Commercial paper played a notable role in the 2008 financial crisis, when the market froze briefly as investors became uncertain about the creditworthiness of issuers. The episode illustrated how, even in instruments that seem straightforward, confidence is the essential ingredient. Commercial paper rate. The commercial paper rate is the interest rate at which corporations borrow through the issuance of commercial paper. It reflects the cost of short-term unsecured borrowing for large, credit-worthy companies and is closely watched as an indicator of short-term credit market conditions. Imagine a thermometer placed in the middle of the short-term credit market. Its reading reflects not just temperature but confidence, the willingness of investors to lend, and the terms on which they are prepared to do so. The commercial paper rate is that thermometer. The commercial paper rate is influenced by the prevailing level of short-term interest rates, set by the central bank, as well as by market demand for short-term instruments and the perceived creditworthiness of commercial paper issuers generally. During periods of financial stress, the commercial paper rate can rise sharply as investors become more cautious about extending unsecured credit to corporate borrowers. This widening spread above risk-free rates signals tightening credit conditions and can constrain corporate liquidity. The rate is published regularly by financial authorities and is used as a benchmark by market participants, economists, and policymakers. It sits quietly in the background of the credit markets, moving with the collective mood of those who lend and those who borrow, a small but precise measure of a very large and interconnected system. Commercial real estate. Commercial real estate refers to property used for business purposes, as opposed to residential use. It includes office buildings, retail spaces, warehouses, industrial facilities, hotels, and multifamily residential properties held as income-generating investments. Picture a city viewed from above, the streets, the rooftops, the movement of people between buildings. A significant proportion of what you see is commercial real estate. The glass office towers. The low warehouse complexes near the motorway. The retail strips along the high street. Each of these properties is an asset, held by someone, generating income, subject to the forces of supply, demand, and economic change. Commercial real estate is valued primarily on its ability to generate rental income. Investors assess a property's occupancy rate, the quality and length of its leases, and the financial strength of its tenants before determining what they are willing to pay. The commercial real estate market is cyclical. During periods of economic growth, demand for office, retail, and industrial space increases, pushing rents and values higher. During recessions, vacancies rise, rents fall, and values decline. The cycle does not repeat on a fixed schedule, but it repeats. Commercial real estate is held by private investors, institutional funds, real estate investment trusts, and corporations that own their own operating premises. It is a large and diverse asset class, illiquid compared to financial securities, but capable of generating steady income over long periods of time. Commission. A commission is a fee paid to an agent, broker, or salesperson for facilitating a transaction or providing a service. It is typically calculated as a percentage of the value of the transaction completed. Think of a completed sale, a property transferred, a security traded, an insurance policy placed. Between the buyer and the seller, or between the client and the market, there was an intermediary. That intermediary performed a service. The commission is the compensation for that service, extracted from the transaction itself. Commissions are common across many areas of finance and commerce. Real estate agents earn commissions on property sales. Stockbrokers have historically charged commissions on securities trades, though many retail brokerage platforms have moved to commission-free models in recent years. Insurance brokers earn commissions from insurers when they place business. The commission structure creates an alignment of incentives between the agent and the successful completion of a transaction. The agent is motivated to close the deal. However, it can also create conflicts of interest. The agent may favor larger or faster transactions over those that are most suitable for the client. Regulatory frameworks in many jurisdictions now require advisors to disclose commissions clearly to clients, ensuring that the nature and amount of any payment are understood. Transparency does not eliminate the commission. It simply ensures that everyone at the table knows what is on it. Commodities exchange. A commodities exchange is a marketplace where buyers and sellers trade standardized contracts for physical goods, such as metals, agricultural products, and energy resources, or financial instruments derived from those goods. Imagine a large, organized hall, or in modern times, a network of electronic trading systems, where the prices of oil and wheat and copper and coffee are continuously discovered through the interaction of buyers and sellers. The goods themselves may be stored in warehouses across the world. What is traded on the exchange is the right to those goods, formalized in standardized contracts. Commodities exchanges serve two essential functions. They provide a mechanism for price discovery, a transparent, continuous process by which supply and demand interact to determine a fair market price. And they provide a hedging mechanism, a way for producers and consumers of commodities to manage the risk of price fluctuations. A farmer who expects to harvest wheat in 3 months can sell futures contracts on a commodities exchange to lock in today's price for that future crop. An airline that will need to purchase jet fuel throughout the coming year can buy contracts to fix that cost in advance. In each case, the exchange makes the hedge possible. Well-known commodities exchanges include the Chicago Mercantile Exchange, the London Metal Exchange, and the Intercontinental Exchange. They operate with considerable precision, standardizing contract sizes, delivery terms, and quality specifications so that trading can proceed efficiently and without ambiguity. Commodity. A commodity is a basic good or raw material that is interchangeable with other goods of the same type and is used as an input in the production of other goods or services. Commodities are traded in bulk and are standardized such that one unit is equivalent to any other. Think of a barrel of crude oil sitting in a storage facility. It is indistinguishable from the barrel beside it. The barrel beside it is indistinguishable from the barrel beside that one. Each unit is the same. Each trades at the same price in the market. This interchangeability, this uniformity, is the defining characteristic of a commodity. Commodities are broadly divided into hard and soft categories. Hard commodities include natural resources that must be mined or extracted, such as gold, silver, copper, and oil. Soft commodities include agricultural products that are grown, such as wheat, corn, cotton, coffee, and soybeans. Because commodities are standardized and widely traded, their prices are determined by global supply and demand. A drought in one part of the world can affect the price of wheat globally. A change in industrial output in one country can affect the price of copper across all markets. Commodity prices are also influenced by currency movements, geopolitical developments, and speculative activity. They move with a logic that is real but not always predictable, responding to the world's physical conditions and to the financial markets that interpret them, simultaneously and continuously. Common stock. Common stock represents ownership shares in a corporation, entitling the holder to a proportional claim on the company's assets and earnings, and typically granting voting rights at shareholder meetings. Picture a corporation divided into many equal parts. Each part is a share of common stock. The person who holds that share holds a fraction of the company, a claim on a proportional portion of its future earnings, and a voice, however small, in its governance. Holders of common stock benefit when the company prospers. If profits grow, dividends may be paid. If the company's value increases, the price of the shares rises. If the company is acquired, shareholders typically receive a premium above the market price of their shares. However, common stockholders also absorb risk. In the event of bankruptcy, they are last in the order of claims, behind secured creditors, unsecured creditors, and preferred stockholders. If the assets of the company are insufficient to satisfy those prior claims, common stockholders may receive nothing at all. The voting rights attached to common stock give shareholders a formal role in major corporate decisions, the election of board directors, approval of significant transactions, and amendments to the company's governing documents. In practice, the votes of small individual shareholders have limited influence. In aggregate, however, they form the legal foundation of corporate accountability. The company belongs, in law, to its common stockholders, and the relationship between them is one of the oldest and most fundamental structures in business. Competitive advantage. A competitive advantage is a condition or characteristic that allows a company to produce goods or services more efficiently, more effectively, or more distinctively than its competitors, enabling it to generate superior returns over time. Think of two companies operating in the same market. They sell similar products. They compete for the same customers. But one of them consistently earns higher margins. Its customers are more loyal. Its costs are lower. Its brand commands a premium. The difference between them, whatever its source, is a competitive advantage. Competitive advantages take many forms. A cost advantage allows a company to produce more cheaply than rivals, enabling it to undercut on price or earn higher margins at the same price. A differentiation advantage allows a company to offer something unique that customers value and are willing to pay more for. A network effect advantage grows as more people use a product or service, making it increasingly valuable to each additional user. Warren Buffett has described a strong competitive advantage as an economic moat, a feature that protects a business from competitive encroachment the way a moat protects a castle. The wider the moat, the more durable the advantage. Competitive advantages are not permanent. They can erode through technological change, regulatory shifts, new entrants, or simple complacency. The history of business is filled with companies that once possessed formidable advantages and later found themselves without them. Maintaining an advantage requires the same discipline as creating one. Compound annual growth rate. The compound annual growth rate, commonly abbreviated as CAGR, is the rate at which an investment or business metric would have grown if it had grown at a steady rate on an annually compounded basis over a specified time period. Imagine a single seed placed in the ground. After 1 year, it has grown. After 2 years, the growth continues, and now it grows not just from the original seed, but from everything that has already grown. Each year's growth builds on all previous growth. The compound annual growth rate describes the consistent yearly rate that would produce the same total result over the entire period. CAGR smooths out the irregular year-to-year fluctuations in performance to provide a single, comparable figure. An investment that grew by 30% in 1 year and declined by 10% in the next did not grow at 10% per year on average. The CAGR calculation produces a more accurate representation of the cumulative growth experience. CAGR is widely used in finance to compare the performance of investments, business metrics, and economic indicators over time. It provides a standardized basis for comparison across different periods and different starting points. The formula is straightforward. divide the ending value by the beginning value, raise the result to the power of 1 divided by the number of years, and subtract 1. The result is a single, quiet number that carries within it the full history of growth, compressed, averaged, and made comparable. Compound dividend. A compound dividend refers to the effect achieved when dividends received from an investment are reinvested to purchase additional shares, which then generate their own dividends, creating a compounding cycle of growth over time. Picture a small deposit made into an account at the beginning of a very long year. At the end of the year, the account pays interest. That interest is added to the balance. The following year, the interest is calculated on the larger balance. This continues, quietly, for years. The compound dividend works in exactly this way, applied not to interest but to the dividends paid by shares. When dividends are reinvested, each dividend payment purchases additional shares. Those additional shares generate their own dividends in future periods. Over long time horizons, this compounding effect can become the dominant driver of total investment return. Many companies and investment funds offer dividend reinvestment programs, sometimes referred to as DRIPs, which automatically reinvest cash dividends into additional shares, often without brokerage fees. The mechanism removes the decision from the investor and makes compounding the default. The effect of compound dividends is most powerful over the longest periods. In the first years, the additional shares generated are modest. But as the base grows, as dividends generate dividends that generate further dividends, the pace of accumulation quietly accelerates. It is one of the least dramatic processes in investing, and one of the most effective. Compound frequency. Compound frequency refers to how often interest is calculated and added to the principal balance of an account or loan within a given period. Common compound frequencies include annually, semi-annually, quarterly, monthly, and daily. Think of a clock that ticks. Each tick represents a moment at which interest is calculated and added. The more frequently the clock ticks, the more times per year the calculation is performed, the more often earned interest begins generating its own interest. The frequency of compounding affects the total amount accumulated over time. An interest rate of 5% compounded annually produces a different result over 10 years than the same rate compounded monthly. The monthly compounding produces a slightly higher outcome, because interest is added to the principal more frequently, giving it more opportunities to itself earn interest before the year is complete. The mathematical relationship between the stated interest rate and the effective rate, once compounding frequency is taken into account, is captured in the concept of the annual percentage yield, or APY. This figure reflects the true annual return, accounting for the frequency of compounding. Compound frequency matters most over long time periods and at higher interest rates. For short durations and low rates, the difference between annual and daily compounding is small. For long durations and higher rates, it becomes meaningful. The clock ticks the same way regardless. But more ticks, compounded over many years, add up. Compound interest. Compound interest is interest calculated on both the initial principal and the accumulated interest from previous periods. Unlike simple interest, which is calculated only on the original principal, compound interest causes a balance to grow at an accelerating rate over time. Imagine a still lake into which a single stone is dropped. The ripple moves outward. Then another stone is dropped, not into the center, but somewhere on the existing ripple. Another ripple begins, interacting with the first. Then another, and another. The surface becomes increasingly complex. What began as a single point of disturbance has become something much larger. Compound interest works in much the same way. In the first period, interest is earned on the principal. In the second period, interest is earned on the principal plus the interest from the first period. In the third period, interest is earned on all of that together. Each period builds on everything that came before. Albert Einstein is often quoted as describing compound interest as the eighth wonder of the world. Whether he said it or not, the sentiment captures something true, that a simple mathematical principle, applied consistently over long periods of time, produces results that can seem extraordinary. The same principle that grows savings also grows debt. A loan on which interest compounds and is not repaid will grow with the same relentless logic. The direction of the effect depends entirely on which side of the ledger you occupy. For the patient saver, compound interest is a quiet ally. For the unprepared borrower, it is a persistent burden. Compound return. A compound return is the total return on an investment over a period of time, taking into account the reinvestment of all gains, including interest, dividends, and capital appreciation, so that each period's gains contribute to future growth. Think of a journey measured not by the distance of each individual step, but by the cumulative progress of every step building on the last. The compound return does not measure any single period's performance. It measures the total effect of all periods together, each one beginning from the position achieved at the end of the previous one. Compound returns differ from simple returns in the same way that compound interest differs from simple interest. A simple return adds up the gains from each period without accounting for the reinvestment effect. A compound return captures the full, accumulated impact of growth building on growth. Over short periods, the difference between a simple return and a compound return is small. Over long periods, 10 years, 20 years, 30 years, the gap can become very significant. An investment that earns 10% per year on a simple basis produces a different outcome than one that earns 10% per year on a compounded basis, with all returns reinvested. The compound return is the most honest measure of investment performance over time. It reflects what an investor actually experienced, not what happened in any single year, but what happened to the money in total, from start to finish, as one year's outcome became the foundation of the next. Compounding. Compounding is the process by which the returns on an investment generate their own returns over time, resulting in exponential growth. It is the mechanism that underlies compound interest and compound returns across all forms of investment. Picture a small mound of earth. Rain falls on it. The earth absorbs the rain and expands slightly. More rain falls. The expanded earth absorbs more than before, and expands a little more. Over a very long time, longer than any single season, the mound becomes something quite different from what it was at the beginning. Compounding works with the same patient accumulation. The power of compounding is most visible over long time horizons. In the early years of an investment, the compounding effect is modest, the base is small, and the returns generated are small. But as the base grows, each year's return is calculated on a larger amount. The pace of growth accelerates, not because the rate has changed, but because the base has grown. Time is the critical ingredient in compounding. An investor who begins early and allows returns to compound for decades will generally outperform an investor who begins later and contributes more, because the earlier investor has allowed more time for the compounding process to operate. Compounding applies equally to debt. Interest on unpaid balances compounds in the same way that returns on investments compound. The mechanism is identical. The direction of the benefit simply reverses. Understanding compounding means understanding both sides of that equation. Concentration risk. Concentration risk is the potential for a significant loss resulting from an excessive exposure to a single asset, sector, geography, counterparty, or other source of risk within a portfolio or financial institution. Imagine a portfolio in which a single investment represents the majority of the total value. When that investment performs well, the portfolio performs well. When it performs poorly, the portfolio performs poorly. The fortunes of the entire holding depend on the outcome of a single bet. That dependency is concentration risk. Concentration risk can arise in many forms. A portfolio that holds only technology stocks is concentrated by sector. A bank that has lent heavily to a single industry is concentrated by client type. A company that generates most of its revenue from a single customer is concentrated by revenue source. In each case, the common feature is an imbalance, too much exposure to one thing. The primary mitigation for concentration risk is diversification, the distribution of exposure across multiple assets, sectors, geographies, and counterparties. A diversified portfolio does not eliminate risk, but it ensures that the failure of any single element does not determine the fate of the whole. Regulatory frameworks typically limit the concentration of risk within banks and other financial institutions. Rules restrict the proportion of capital that can be lent to a single borrower or group of connected borrowers. The limits exist because experience has shown, repeatedly, that concentration is one of the most reliable precursors to significant financial loss. Conduit. In finance, a conduit is a legal entity or structure used to channel funds or assets from one party to another, often for the purpose of raising capital, managing risk, or achieving a specific regulatory or tax treatment. It acts as a pass-through vehicle, without holding assets on a long-term basis. Think of a pipe running beneath a city. Water enters at one end and exits at the other. The pipe does not hold the water. It does not transform it. It simply channels it from its origin to its destination, efficiently and without interruption. A financial conduit performs a structurally similar function, directing the flow of funds or assets between parties. Conduits are commonly used in securitization. A bank may transfer loans to a conduit entity, which then issues securities backed by those loans to investors. The loans leave the bank's balance sheet. The conduit holds them temporarily and passes the cash flows through to the investors. The bank receives fresh capital. The investors receive income. The conduit is simply the mechanism through which this arrangement operates. Asset-backed commercial paper conduits, which were widely used in the years before the 2008 financial crisis, held large quantities of long-term assets funded by the issuance of short-term commercial paper. When the commercial paper market froze during the crisis, many conduits experienced acute funding difficulties. The conduit itself is not the strategy. It is the infrastructure through which a strategy operates. Simple in concept, and often intricate in construction. Conglomerate. A conglomerate is a large corporation that owns and operates businesses across multiple, often unrelated industries. Rather than specializing in a single sector, a conglomerate diversifies its activities across a broad range of business areas. Picture a holding company whose subsidiaries include a food manufacturer, an insurance group, a media company, and an industrial equipment supplier. The businesses do not share customers or supply chains. They share a parent. That parent is a conglomerate, an entity that has grown not by deepening its focus in one direction, but by expanding in many. Conglomerates were particularly common in the mid-20th century, when diversification was widely viewed as a corporate virtue. The theory was that spreading activities across multiple industries would smooth out the inevitable volatility of any single sector. In more recent decades, opinion has shifted. Many investors and analysts now prefer focused companies with clear, understandable business models. The argument against conglomerates is that they are difficult to value, complex to manage, and tend to trade at a discount to the sum of their individual parts, a phenomenon known as the conglomerate discount. Nevertheless, some of the world's most successful companies are conglomerates. Berkshire Hathaway, the investment vehicle of Warren Buffett, holds businesses spanning insurance, rail transport, energy, retail, and manufacturing. Its diversification is deliberate, long-term, and managed with considerable discipline. It is an exception, but it is a notable one. Conservatorship. A conservatorship is a legal arrangement in which a court appoints an individual or institution, the conservator, to manage the financial affairs and assets of a person or entity that is deemed unable to manage those affairs independently. In financial contexts, it is also used to describe government oversight of a failing financial institution. Think of a structure placed around something fragile, not to confine it unnecessarily, but to support it, to protect it from further deterioration, and to manage its affairs until stability is restored or a more permanent resolution is determined. In personal finance law, conservatorships are typically established for individuals who have become incapacitated due to age, illness, or disability. The conservator is responsible for managing the conservatee's assets, paying their bills, and making financial decisions in their best interest. In the financial crisis of 2008, the United States government placed the mortgage finance giants Fannie Mae and Freddie Mac into federal conservatorship. These entities, which had guaranteed a large proportion of American home mortgages, had become severely undercapitalized. The conservatorship allowed the government to stabilize them, continue their operations, and manage their affairs without immediately winding them down. A conservatorship is not permanent. It is a form of supervised management, a framework applied when ordinary management has failed or is no longer possible, designed to preserve what exists while a longer-term course of action is considered. Consumer confidence. Consumer confidence is a measure of how optimistic or pessimistic consumers are about the current and future state of the economy and their own financial situation. It reflects the general sentiment of households regarding their willingness to spend and make major financial commitments. Picture a large survey distributed across a country on a given day. Respondents are asked how they feel about their current financial position, their job security, and their expectations for the economy over the coming months. The aggregated responses, thousands of individual opinions about the present and the future, produce a single index. That index is the consumer confidence reading. Consumer confidence matters because consumer spending accounts for a large share of economic activity in most developed economies. When consumers feel confident, they are more likely to spend, borrow, and make significant purchases such as homes, vehicles, and appliances. When confidence falls, spending contracts and economic growth slows. Consumer confidence indices are published regularly by various organizations. In the United States, well-known measures include those produced by the Conference Board and the University of Michigan. These reports are watched closely by economists, investors, and policymakers. Consumer confidence is a leading indicator. It tends to shift before the broader economic data follows. A sudden decline in confidence can signal deteriorating conditions before they appear in employment figures or growth statistics. It is not a precise instrument, but it captures something real, the collective mood of millions of households making decisions about tomorrow based on how today feels. Consumer confidence. Consumer confidence is a measure of how optimistic or pessimistic consumers are about the current and future state of the economy and their own financial situation. It reflects the general sentiment of households regarding their willingness to spend and make major financial commitments. Picture a large survey distributed across a country on a given day. Respondents are asked how they feel about their current financial position, their job security, and their expectations for the economy over the coming months. The aggregated responses, thousands of individual opinions about the present and the future, produce a single index. That index is the consumer confidence reading. Consumer confidence matters because consumer spending accounts for a large share of economic activity in most developed economies. When consumers feel confident, they are more likely to spend, borrow, and make significant purchases such as homes, vehicles, and appliances. When confidence falls, spending contracts and economic growth slows. Consumer confidence indices are published regularly by various organizations. In the United States, well-known measures include those produced by the Conference Board and the University of Michigan. These reports are watched closely by economists, investors, and policymakers. Consumer confidence is a leading indicator. It tends to shift before the broader economic data follows. A sudden decline in confidence can signal deteriorating conditions before they appear in employment figures or growth statistics. It is not a precise instrument, but it captures something real, the collective mood of millions of households making decisions about tomorrow based on how today feels. Consumer credit. Consumer credit refers to the credit extended to individuals, rather than to businesses, to finance personal purchases and expenditures. It includes credit cards, personal loans, auto loans, student loans, and other forms of borrowing available to private individuals. Think of the many small arrangements that allow people to acquire things before they have fully paid for them. The furniture purchased on installment. The holiday financed on a credit card. The car bought with a loan repaid monthly over 4 years. Each of these is a form of consumer credit, an agreement that allows spending to precede the accumulation of the funds required. Consumer credit is a major feature of modern economies. Its availability allows individuals to smooth their consumption over time, acquiring goods and services whose cost they will meet gradually. It supports demand in the short term, enabling purchases that might otherwise be delayed for years. However, consumer credit also carries risk. Borrowing at high interest rates, as is common with credit cards, can create a cycle of debt that is difficult to exit. When total consumer debt levels rise significantly relative to incomes, it can signal financial fragility within households and across the broader economy. Consumer credit conditions are monitored by central banks and financial regulators as indicators of household financial health. The total stock of consumer credit, delinquency rates, and average interest rates are reviewed regularly, each one offering a different angle on the same quiet, pervasive financial arrangement. Consumer debt. Consumer debt refers to the total amount owed by individuals as a result of borrowing for personal consumption, including credit card balances, personal loans, auto loans, and student loans. It represents the accumulated financial obligations of households. Imagine a ledger maintained for an entire country, not the ledger of a company, but the collective ledger of millions of households. On one side, assets, savings accounts, property, pension funds. On the other, liabilities, mortgages, credit cards, loan balances. The total of those personal liabilities, the money owed for consumption already enjoyed, is consumer debt. Consumer debt has grown significantly in many economies over recent decades, rising relative to household incomes as access to credit expanded and interest rates declined. In absolute terms, the numbers are very large. In context, what matters is the relationship between debt levels and incomes, and the ability of households to service their obligations. High levels of consumer debt can constrain future spending. When a large proportion of household income is directed toward debt repayment, less is available for new consumption. This dynamic can act as a brake on economic growth, particularly following periods of rapid credit expansion. Consumer debt also has a personal dimension. Behind the aggregate statistics are individual households navigating the specific consequences of their borrowing decisions, the monthly payment due, the balance that does not diminish quickly, the slow arithmetic of repayment. Finance, at this level, is not abstract. It is experienced one statement at a time. Consumer Price Index. The Consumer Price Index, commonly abbreviated as CPI, is a measure of the average change over time in the prices paid by urban consumers for a standardized basket of goods and services. It is the most widely used measure of inflation in many countries. Think of a shopping trolley filled with a representative selection of goods, food, clothing, housing costs, healthcare, transportation, education, and a range of other items typically purchased by households. The price of that trolley is measured at regular intervals. The change in the total price of the trolley over time is the Consumer Price Index. The CPI is published monthly by national statistical agencies. In the United States, it is produced by the Bureau of Labor Statistics. In the United Kingdom, it is published by the Office for National Statistics. The methodology involves collecting price data from thousands of retail outlets and service providers across the country. Central banks pay close attention to CPI data. In many jurisdictions, maintaining price stability, keeping inflation close to a target, typically around 2% per year, is a primary mandate of the central bank. When CPI rises above that target, the central bank may raise interest rates to slow demand and reduce inflationary pressure. The CPI is used for many practical purposes, adjusting wages in employment contracts, indexing government benefits, and setting the terms of inflation-linked financial instruments. It is a number that appears in financial news regularly, reported without drama, carrying within it the cumulative effect of price changes across an entire economy. Consumer surplus. Consumer surplus is the economic benefit received by a consumer when they pay less for a good or service than they would have been willing to pay. It represents the difference between the maximum price a consumer would pay and the actual price they pay. Imagine walking into a bookshop and finding a book you have wanted to read for years. You had been prepared to pay $30 for it. The price on the shelf is $18. You purchase it immediately. The $12 you did not have to spend, the gap between what you were willing to pay and what you actually paid, is your consumer surplus in that transaction. Consumer surplus arises because sellers generally charge a single price to all buyers, even though different buyers would have been willing to pay different amounts. The buyers who would have paid more than the market price effectively receive a windfall, the gap between their private valuation and the price charged. Consumer surplus is a concept from welfare economics, used to measure the benefit that consumers derive from their participation in markets. When added to produce a surplus, the benefit accruing to sellers, the combined measure is called total surplus, or social welfare. Economists use consumer surplus to evaluate the impact of pricing decisions, taxes, and policies on consumer welfare. A price increase reduces consumer surplus. A tax on a good reduces it further. A subsidy increases it. These effects are quiet but real, experienced in the daily transactions of millions of consumers who are rarely aware that their benefit is being measured. Consumption tax. A consumption tax is a tax levied on the purchase of goods and services, rather than on income or wealth. It is applied at the point of consumption, when something is bought, and is typically included in or added to the price paid by the consumer. Think of every purchase made in the course of an ordinary day. A coffee in the morning. A train ticket. A sandwich at midday. A pair of shoes. In many countries, a proportion of each of these prices consists of a consumption tax, a quiet, consistent levy that accompanies spending wherever it goes. The most common forms of consumption tax are value-added tax, known as VAT in many countries, and sales tax. VAT is applied at each stage of the production and distribution process, with businesses reclaiming the tax they have paid on inputs, so that the final consumer bears the full amount. Sales tax, common in the United States, is applied only at the point of final sale to the consumer. Consumption taxes are considered relatively efficient because they do not distort the decision to work or save in the way that income taxes can. They are also considered regressive, however. Lower-income households spend a higher proportion of their income on consumption, and therefore bear a proportionally greater burden. Governments rely on consumption taxes as a significant source of revenue. The rates and coverage of these taxes vary considerably across jurisdictions, but the basic mechanism is consistent. The act of spending generates a transfer to the public purse, reliably and continuously, with every transaction. Contango. Contango is a condition in futures markets in which the futures price of a commodity or asset is higher than the expected spot price at the time of the contract's maturity. It results in an upward-sloping futures curve, where contracts for delivery further in the future trade at higher prices than those for delivery sooner. Picture a timeline laid across a table. At the left end is today's price for a barrel of oil. Moving to the right, toward future delivery dates, the price is incrementally higher. 3 months out is slightly more expensive. 6 months out is more expensive still. 12 months out is the highest of all. This upward slope is contango. Contango typically arises when there is an expectation that the spot price will rise, or when the cost of storing and financing the commodity until the delivery date is reflected in the futures price. Storage costs, insurance, and the opportunity cost of capital are all embedded in the futures price. For investors who hold futures positions by continuously rolling contracts forward, selling an expiring contract and buying the next one, contango creates a negative return. They repeatedly sell the lower-priced contract and buy the higher-priced one, experiencing a persistent loss from the roll itself, independent of any change in the underlying spot price. Contango is the normal condition in many commodity markets. Its opposite, backwardation, occurs when futures prices are lower than the expected spot price, typically when there is near-term scarcity or high immediate demand for the physical commodity. Contingency fund. A contingency fund is a reserve of money set aside to cover unexpected expenses or financial emergencies. It is maintained separately from operational budgets and is intended to provide financial stability during unforeseen circumstances. Think of a sealed container placed carefully at the back of a very organized cupboard. It is not for everyday use. It is not intended to be opened on a Tuesday afternoon for a routine expense. It is there for the moment when something unexpected arrives, an equipment failure, a sudden shortfall in revenue, an emergency requiring immediate expenditure. The contingency fund is that container. At the individual level, a contingency fund serves as a financial buffer, a cushion against sudden income loss, unexpected medical costs, or urgent household repairs. Financial planners commonly recommend holding 3 to 6 months of living expenses in a readily accessible contingency fund. At the organizational level, contingency funds are budgeted explicitly as part of project planning and corporate financial management. Construction projects, government programs, and large infrastructure initiatives typically include contingency allocations, a percentage of the total budget set aside for costs that cannot be predicted in advance. A contingency fund is most valuable precisely when it is least expected to be needed. Its presence transforms an emergency into a manageable event. Its absence transforms the same event into a crisis. The fund sits quietly, earning a modest return, hoping not to be required, and waiting, with perfect patience, in case it is. Contingent liability. A contingent liability is a potential financial obligation that may arise depending on the outcome of a future event, such as a lawsuit, a guarantee, or a warranty claim. It is not certain to occur, and its amount, if it does occur, may not be precisely known. Imagine a legal case still in progress. The outcome is uncertain. If the judgment goes against the company, a payment will be required. If the judgment is favorable, no payment will be necessary. The potential obligation sits in this uncertain state, real enough to be disclosed, not certain enough to be recorded as a definite liability. This is the nature of a contingent liability. Under accounting standards, contingent liabilities must be disclosed in the notes to a company's financial statements when they are considered possible. If they are probable and their amount can be reliably estimated, they are recorded as a provision on the balance sheet. Common sources of contingent liabilities include pending litigation, product warranties, financial guarantees issued on behalf of other parties, and environmental remediation obligations. Their disclosure allows users of financial statements to assess potential future claims on the company's resources. Contingent liabilities are watched carefully by analysts and creditors. A company with large contingent liabilities carries risks that do not fully appear in its balance sheet. The obligations are there, in the notes, in the small print, in the documentation of ongoing uncertainties, present even when they are not yet certain. Contractionary policy. Contractionary policy refers to measures taken by a government or central bank to reduce economic activity, slow inflation, or decrease the money supply. It is the opposite of expansionary policy and is typically deployed when an economy is growing too quickly and inflation is rising. Think of a fire that has grown larger than intended. The original warmth was welcome, but the heat has become excessive. The response is not to add more fuel. It is to reduce the supply, to allow the fire to diminish toward a more manageable temperature. Contractionary policy applies this logic to an economy. The primary tool of contractionary monetary policy is the raising of interest rates. When borrowing becomes more expensive, consumers spend less and businesses invest less. Demand falls. Inflationary pressure eases. The central bank achieves its objective by making credit more costly. Contractionary fiscal policy involves reducing government spending, increasing taxes, or both. By withdrawing stimulus from the economy, the government reduces aggregate demand, slowing the pace of growth and the rate of price increases. Contractionary policy is rarely popular at the time it is applied. Higher interest rates reduce the affordability of mortgages and consumer credit. Tax increases reduce disposable income. The effects are felt broadly and immediately. The benefits, lower inflation, a more stable economic environment, tend to emerge more slowly. Policy makers who apply contractionary measures do so knowing this, and often in the face of considerable opposition. Contractual obligation. A contractual obligation is a duty or commitment that arises from a legally binding agreement between two or more parties. It specifies what each party is required to do, or refrain from doing, as a condition of the contract. Picture a document signed in two places. Above each signature, a set of terms. Below each signature, a set of responsibilities. The moment the ink is dry, the responsibilities become obligations. Not suggestions. Not intentions. Obligations, enforceable by law, binding on each party who signed. Contractual obligations take many forms in finance. A borrower is obligated to repay a loan according to its terms. A company is obligated to deliver goods or services agreed in a commercial contract. A bond issuer is obligated to make interest and principal payments on the date specified. Each of these is a contractual obligation, created by agreement and protected by law. Failure to meet a contractual obligation constitutes a breach of contract. The non-breaching party may be entitled to seek damages, specific performance, or other remedies under the applicable legal framework. Understanding contractual obligations is fundamental to financial practice. Before entering into any significant agreement, parties examine their obligations carefully, the timing, the amount, the conditions, and the consequences of non-performance. The obligation is not merely a legal formality. It is the substance of the agreement itself, the thing that gives the contract its meaning and its weight. Convertible bond. A convertible bond is a type of corporate bond that gives the holder the option to convert the bond into a specified number of the issuing company's shares, at a predetermined conversion price, under certain conditions. Think of a document that begins its life as a loan, a fixed income instrument paying regular interest, with a maturity date on which the principal will be repaid. But inside that document is an additional feature, a door. If the conditions are right, the bondholder may choose to open that door and exchange the bond for shares in the company. The bond is convertible. Convertible bonds appeal to a particular type of investor. They offer the income and relative security of a bond, with the additional potential upside of equity participation if the company's share price rises above the conversion price. This combination of protection and possibility makes them attractive in specific market environments. For the issuing company, convertible bonds offer a way to raise capital at a lower interest rate than a conventional bond would command. Investors accept the reduced income in exchange for the conversion feature. If the share price performs well, both parties may benefit. The conversion option becomes more valuable as the share price rises. When the share price significantly exceeds the conversion price, the convertible bond trades more like an equity than a fixed income instrument. When the share price is well below the conversion price, it trades primarily as a bond. In between, it occupies a quiet middle ground, part debt, part option, fully dependent on what the share price does next. Convertible note. A convertible note is a form of short-term debt used primarily in early-stage startup financing, which converts into equity, typically shares in the company, upon the occurrence of a specified future event, such as a subsequent funding round. Imagine a small piece of paper representing a loan made to a company that does not yet have an established valuation. The lender and the company agree that rather than repaying the loan in cash at a fixed date, the debt will convert into shares when the company raises its next significant round of investment. At that point, the note becomes equity. The lender becomes a shareholder. Convertible notes are popular in venture capital and startup financing because they allow early investors to provide capital quickly, without requiring the company to establish a formal valuation at an early and uncertain stage. The valuation question is deferred to the next funding round. Convertible notes typically include a discount rate, which entitles the note holder to purchase shares at a lower price than investors in the subsequent round, in recognition of the earlier risk they accepted. They may also include a valuation cap, a maximum price at which the notes will convert, protecting the investor if the company's valuation rises dramatically. The convertible note is a practical solution to an inherent problem in early-stage investing, the difficulty of agreeing on a price for something whose value is still being determined. It defers the question while keeping both parties financially aligned. Simple in principle, and often carefully structured in practice. Core capital. Core capital refers to the primary, highest quality capital held by a financial institution, typically common equity and disclosed reserves, that is available to absorb losses and support ongoing operations. It forms the foundation of a bank's regulatory capital structure. Think of the load-bearing walls of a building. Other walls exist, providing additional support. But these particular walls are the ones on which the entire structure depends. Remove them and the building cannot stand. Core capital is the financial equivalent, the structural foundation of a bank's capacity to absorb losses and remain solvent. In regulatory frameworks, core capital is often referred to as Tier 1 capital. Under the Basel III framework, Tier 1 capital consists primarily of common equity Tier 1, which includes common shares, retained earnings, and other qualifying instruments. This is considered the most reliable form of loss-absorbing capital because it is permanent, does not need to be repaid, and is subordinate to all other claims. Regulators require banks to maintain minimum levels of core capital relative to their risk-weighted assets. These ratios are set to ensure that banks can absorb a meaningful level of losses before becoming insolvent, providing a buffer that protects depositors, creditors, and the broader financial system. Core capital ratios are disclosed publicly and reviewed regularly by supervisory authorities. They are one of the primary metrics used to assess the financial health of a bank, a quiet number that represents the margin between stability and distress, maintained with considerable care. Core earnings. Core earnings refer to the profits generated by a company's primary, ongoing business operations, excluding one-time items, non-recurring charges, and other items considered to be outside the normal course of business. They represent the sustainable, underlying profitability of the enterprise. Imagine peeling back the surface of a company's income statement. Beneath the headline profit figure lie many components, the regular revenues and costs of operating the business, but also restructuring charges, asset write-downs, litigation settlements, and gains from asset sales. Core earnings is what remains once those non-recurring items have been set aside, the earnings that are expected to persist, quarter after quarter, year after year. Analysts and investors focus on core earnings because they provide a more reliable basis for valuing a company and projecting future performance. A company that reports a large profit because it sold a division, but whose underlying operations are barely breaking even, is in a very different position from one whose core operations are steadily profitable. The definition of core earnings is not standardized. Different companies and analysts may exclude different items, making comparisons across companies imprecise. This subjectivity is a limitation. It requires careful examination of what has been included and excluded, and why. Core earnings is an attempt to see through the noise and find the signal, the persistent, repeatable capacity of a business to generate profit through its ordinary operations. It is what the company does, every day, stripped of the exceptional and the incidental. Core inflation. Core inflation is the rate of price increase in an economy, measured by excluding food and energy prices from the standard consumer price index. It is used as a measure of the underlying, persistent trend in inflation, stripped of the more volatile components. Think of a river whose surface is disturbed by wind. The surface movement is real, but it is temporary, it does not reflect the deeper current. Food and energy prices are like that surface movement, volatile, often driven by short-term supply disruptions, weather events, and geopolitical developments. Core inflation attempts to see past that surface to the current beneath. Food and energy prices are excluded from core inflation because they are subject to significant, sudden movements that do not reflect underlying demand pressures in the broader economy. A cold winter can push energy prices sharply higher. A drought can send agricultural prices upward. These events are real, but they are not necessarily signals of persistent inflation. Central banks pay close attention to core inflation when setting monetary policy. Because they cannot quickly respond to supply-side shocks in food and energy markets, they focus on the broader trend in price changes that monetary policy can actually influence. Core inflation is not a perfect measure. Critics point out that food and energy are real costs that households must bear, and that excluding them from the inflation measure understates the experience of price rises for ordinary consumers. It is a tool, useful for one purpose, incomplete for another, like most measures in economics. Corporate bond. A corporate bond is a debt instrument issued by a company to raise capital from investors. In exchange for lending money to the corporation, bondholders receive regular interest payments and the return of their principal at maturity. Picture a company that needs to raise a large sum, more than a single bank would lend, and without the dilution that issuing new shares would cause. It issues a bond, a formal promise to pay interest on a regular schedule and to return the principal on a specific future date. Investors who purchase the bond become creditors of the company. The company receives the capital it needs. The arrangement is recorded in a document and governed by its terms. Corporate bonds are issued by companies of all sizes and credit qualities. Investment-grade bonds are issued by companies considered financially sound, with a low risk of default. High-yield bonds, also known as junk bonds, are issued by companies with lower credit ratings, offering higher interest rates to compensate investors for the greater risk. Corporate bonds are traded in secondary markets, where their prices fluctuate with changes in interest rates and the perceived creditworthiness of the issuer. When interest rates rise, bond prices generally fall. When a company's financial condition deteriorates, the price of its bonds typically declines as well. The corporate bond market is enormous. It provides a crucial source of financing for businesses and an important asset class for investors seeking income. It operates quietly, in the background of the economy, channeling savings toward productive enterprise, one bond at a time. Corporate default. A corporate default occurs when a company fails to meet the terms of its debt obligations, typically by missing an interest payment, failing to repay principal at maturity, or otherwise breaching the covenants of a loan or bond agreement. Think of a long series of scheduled payments, each one expected to arrive at a certain date. For a time, they arrive as anticipated. Then one does not. The payment that was due is not made. The lender waits. The deadline passes. The default has occurred. Corporate defaults vary in severity. A technical default may arise from a breach of a financial covenant, a ratio that has fallen below a specified threshold, without any immediate inability to make cash payments. A payment default involves an actual failure to make an interest or principal payment. Following a default, a complex process begins. Creditors assess their options. The company may enter negotiations to restructure its debt, extending maturities, reducing interest rates, or exchanging debt for equity. If a resolution cannot be reached, formal insolvency proceedings may follow. The consequences of a corporate default extend beyond the company itself. Employees, suppliers, customers, and the communities in which the company operates are all affected. Bondholders and lenders face losses. Rating agencies downgrade the company's remaining obligations. Default is not a quiet event, though the financial conditions that lead to it often develop slowly, in documents and figures that most people do not read until it is too late. Corporate finance. Corporate finance is the branch of finance that deals with the financial decisions made by corporations and the tools and methods used to make those decisions. Its primary goals are to maximize shareholder value while managing the company's financial risks. Think of the financial architecture of a company, not its products or its people, but the structure of its funding, the management of its capital, and the decisions about where to invest and how to return value to those who own it. Corporate finance is the discipline that designs and maintains that architecture. The three central questions of corporate finance are: where should the company invest its resources? How should those investments be financed? And what should be done with the profits generated? These questions, while simple to state, require considerable analysis to answer well, and the answers change as circumstances evolve. Corporate finance encompasses capital budgeting, the process of evaluating and selecting long-term investments. It encompasses capital structure decisions, the choice between debt and equity financing. And it encompasses working capital management, the day-to-day management of the company's short-term assets and liabilities. Corporate finance practitioners include chief financial officers, treasurers, investment bankers, and financial analysts. They work with models, forecasts, and financial statements, always in the service of the same underlying question: how can the financial resources of this organization be managed most effectively in the long-term interest of those who have entrusted their capital to it? Corporate governance. Corporate governance refers to the system of rules, practices, and processes by which a company is directed and controlled. It encompasses the relationships between a company's management, its board of directors, its shareholders, and other stakeholders. Imagine the interior of a well-run institution, not the products it makes or the services it delivers, but the structure by which it makes decisions. Who has authority? To whom are they accountable? How are conflicts of interest managed? How is information disclosed? These questions, and the answers embedded in a company's policies and practices, define its corporate governance. Good corporate governance serves several purposes. It protects the interests of shareholders by ensuring that management acts in their behalf rather than in management's own interest. It provides transparency, the regular and honest disclosure of financial performance, risks, and material events. And it establishes accountability, mechanisms by which managers can be questioned, challenged, and, if necessary, replaced. Key elements of corporate governance include the independence of the board of directors, the quality of audit and risk oversight, executive compensation structures, shareholder voting rights, and the protection of minority shareholders. Failures of corporate governance have been at the center of many of the most significant corporate scandals in financial history. The lesson of each has been similar: when accountability is weak, when oversight is absent, and when the interests of those in control diverge too far from the interests of those who depend on them, the consequences can be severe and wide-ranging. Corporate raider. A corporate raider is an investor who acquires a significant stake in a publicly traded company, often against the wishes of the company's management, with the intention of influencing or taking control of the company, typically to unlock value through restructuring, asset sales, or other changes. Picture an investor reviewing the financial statements of a company whose market value appears, in their assessment, to be significantly below its intrinsic worth. The assets are undervalued. The management is inefficient. The company could be worth considerably more if run differently, or broken apart and its components sold separately. The investor begins to buy shares. The term corporate raider was widely used in the 1980s, when hostile takeovers became a prominent feature of the financial landscape. Figures such as Carl Icahn and T. Boone Pickens acquired large stakes in companies whose management resisted them, using the leverage of their shareholding to push for changes or to extract a premium by selling their stake back to the company. The techniques of corporate raiders included the tender offer, in which an acquirer offers to purchase shares directly from public shareholders at a premium to the market price, bypassing management. Defensive measures developed by target companies included the poison pill, which diluted the acquirer's stake, and the white knight, a friendly acquirer brought in to forestall a hostile takeover. Corporate raiders were controversial, viewed by some as necessary enforcers of shareholder value, and by others as destructive forces whose interest lay primarily in short-term financial gain rather than the long-term health of the companies they targeted. Corporate restructuring. Corporate restructuring refers to significant changes made to a company's organizational structure, operations, or financial arrangements in order to improve its efficiency, profitability, or financial position. It may involve asset sales, workforce reductions, debt renegotiation, or changes to the business model. Think of a building that was designed for one purpose but must now serve another. Some walls need to come down. Others need to go up. The infrastructure must be rerouted. The process is disruptive, but its aim is to produce a structure better suited to the demands that will be placed upon it going forward. Corporate restructuring is this process, applied to an organization. Restructuring can be prompted by financial distress. A company struggling with excessive debt may restructure by negotiating new terms with creditors or converting debt to equity. It can also be undertaken proactively. A company in reasonable health may restructure to improve operational efficiency or to refocus on its core activities. Common elements of corporate restructuring include divesting non-core business units, consolidating operations, reducing headcount, renegotiating supplier and customer contracts, and reorganizing the legal and corporate structure of the enterprise. Restructuring is rarely comfortable for those involved. It creates uncertainty. It involves difficult decisions about people and assets. Its benefits, a leaner, more focused, more financially stable organization, tend to emerge over time rather than immediately. The process is managed with care, documented in considerable detail, and measured in the months and years that follow. Corporate tax. Corporate tax is a direct tax levied by governments on the profits earned by corporations. It is calculated as a percentage of the company's net income, its revenues less allowable deductions such as operating expenses, depreciation, and interest payments. Picture a company at the end of its financial year. Its accountants have calculated the revenues. They have deducted the costs. The result is profit. A specified percentage of that profit will be paid to the government. That payment is corporate tax, a contribution to the public finances made in proportion to the company's financial success. Corporate tax rates vary significantly across countries. Some jurisdictions set rates above 30%. Others have reduced their rates considerably in recent decades to attract business investment. The competition between countries to offer lower corporate tax rates, sometimes referred to as a race to the bottom, has been a persistent feature of international tax policy. The corporate tax base, what counts as profit for tax purposes, is determined by a combination of accounting rules and specific tax legislation. Allowable deductions, depreciation methods, and the treatment of losses carried forward all affect the effective tax rate a company pays, which may differ considerably from the headline statutory rate. Multinational corporations operate across many tax jurisdictions, creating complex questions about where profits should be declared and taxed. International efforts to address profit shifting and base erosion, including agreements on minimum corporate tax rates, have been ongoing in recent decades. The debate is technical, slow-moving, and consequential. Corporate yield. Corporate yield refers to the return an investor earns by holding a corporate bond, expressed as an annual percentage of the bond's price. It reflects both the interest payments made by the bond and any gain or loss from the difference between the purchase price and the redemption value. Think of a bond sitting in a portfolio. It pays interest twice a year. It was purchased at a price slightly below its face value. At maturity, the face value will be returned. The total return from holding that bond, the interest received plus the gain from the price difference, expressed as a percentage of the purchase price on an annual basis, is the corporate yield. Corporate yields are quoted in the market on a yield-to-maturity basis, which calculates the total return assuming the bond is held until its maturity date and all interest payments are reinvested at the same rate. This provides a standardized measure for comparing bonds of different prices, coupon rates, and maturities. Corporate yields are higher than the yields on comparable government bonds, because corporations carry a greater risk of default than sovereign governments in their own currency. The difference between a corporate yield and the equivalent government bond yield is known as the credit spread, a measure of the additional return investors demand for accepting corporate credit risk. A rising corporate yield can signal that investors are becoming more concerned about the creditworthiness of the issuer, or that broader interest rates are moving higher. A declining yield suggests the opposite. The yield is a compact expression of many things at once: price, income, risk, and expectation, all resolved into a single, quietly informative number. Correlation. Correlation is a statistical measure that describes the degree to which two variables move in relation to each other. In finance, it is used to assess the relationship between the returns of different assets or securities. Think of two instruments being played side by side. Sometimes they move in the same direction. When one rises in pitch, the other rises too. Sometimes they move in opposite directions. When one rises, the other falls. Sometimes their movements appear entirely unrelated. Correlation attempts to quantify this relationship, assigning it a number between -1 and +1. A correlation of +1 indicates that two assets move perfectly together. When one rises by 5%, the other also rises by 5% every time. A correlation of -1 indicates that they move perfectly in opposition. A correlation of 0 suggests no consistent relationship between their movements. In portfolio construction, correlation is a critical concept. Combining assets with low or negative correlations reduces the overall volatility of a portfolio, because losses in one asset are offset by gains in another. This is the mathematical foundation of diversification. However, correlations are not fixed. They change over time, sometimes dramatically during periods of market stress. Assets that appeared uncorrelated in normal conditions may suddenly move together during a crisis, reducing the diversification benefit precisely when it is most needed. Correlation is a useful tool. Like all tools, it is most valuable when its limitations are understood. Cost averaging. Cost averaging, also known as dollar cost averaging, is an investment strategy in which a fixed amount of money is invested at regular intervals, regardless of the price of the asset at each point in time. Over time, this results in purchasing more units when prices are low and fewer when prices are high. Picture an investor who commits to investing a fixed sum each month, on the same date, without exception, without regard to whether prices have risen or fallen since the previous purchase. Some months, the price is high and fewer units are acquired. Other months, the price is lower and more units are acquired. Over time, the average cost per unit reflects a blend of those varied purchase prices. The primary benefit of cost averaging is that it removes the pressure of timing the market. Rather than attempting to identify the optimal moment to invest, a task that even professional investors struggle with consistently, the investor simply invests at regular intervals and allows the averaging effect to do its work. Cost averaging is particularly well suited to long-term investors with a regular income, those who invest a portion of each month's salary into a pension or investment account. The strategy is systematic, disciplined, and free from the emotional responses that can distort investment decisions. Cost averaging does not guarantee a profit or protect against loss in declining markets. Its value lies not in eliminating risk, but in reducing the impact of poor timing. It is a strategy built not on predicting the future, but on behaving consistently within it. Cost basis. Cost basis is the original value or purchase price of an asset for tax purposes. It is used to calculate the capital gain or loss when the asset is eventually sold. The difference between the sale price and the cost basis determines the taxable amount. Think of a ledger entry made on the day a purchase was completed. The date, the price, the quantity. That entry does not change with the market. The asset may increase in value or decrease in value. The cost basis remains what it was on the day the purchase occurred. It is the anchor point against which all future transactions are measured. Cost basis includes not just the original purchase price, but also any commissions, fees, or other acquisition costs that were incurred at the time of purchase. In some cases, it is adjusted over time. For example, when dividends are reinvested into additional shares, the cost basis of those additional shares is added to the total. Calculating cost basis can become complex when an investor has made multiple purchases of the same asset at different prices over time. Different accounting methods, specific identification, first in first out, and average cost, produce different cost basis figures and therefore different tax outcomes. Accurate record-keeping of cost basis is the quiet discipline behind efficient tax management. The original purchase slip, the brokerage confirmation, the reinvestment notice, each one contributes to the record that will eventually be needed. The gain or loss is always calculated against a number recorded in the past, which is why the records of the past matter as much as the decisions of the present. Cost-benefit analysis. A cost-benefit analysis is a systematic process for evaluating the financial and non-financial costs and benefits of a decision, project, or policy, in order to determine whether the benefits outweigh the costs and to what degree. Picture a large sheet of paper divided down the middle. On the left side, everything that will be given up, money spent, time consumed, resources deployed, risks accepted. On the right side, everything that will be gained, revenue generated, savings achieved, problems solved, value created. The analysis is the act of populating both columns carefully and then comparing them. Cost-benefit analysis is used across a wide range of contexts: government policy evaluation, corporate investment decisions, infrastructure planning, and regulatory assessment. In each case, the goal is the same: to make explicit the trade-offs involved in a decision, rather than allowing them to remain implicit and unexamined. A thorough cost-benefit analysis attempts to quantify all relevant factors, including those that do not have obvious market prices. The time saved by a new road. The health benefits of cleaner air. The environmental cost of a development project. Assigning numbers to these factors requires judgment, and the judgments made can significantly influence the outcome. Cost-benefit analysis does not make decisions. It informs them. It is a structured way of thinking about choices, a discipline that forces those who must decide to consider, carefully and in writing, what they are trading and what they expect to receive in return. Cost efficiency. Cost efficiency refers to the ability of an organization to achieve its objectives while minimizing the resources consumed, producing the maximum output for a given level of input, or achieving a given output at the lowest possible cost. Think of two factories producing the same product. Both deliver goods of identical quality. Both operate the same number of hours per day. One uses fewer materials, less energy, and a leaner workforce to produce the same volume. That factory is more cost efficient. It achieves the same result at a lower cost. Cost efficiency is a continuous goal in business. It is pursued through process improvement, technology investment, supply chain optimization, workforce training, and the elimination of waste. It is not achieved once and then maintained automatically. It requires ongoing attention and discipline. In financial analysis, cost efficiency is often measured through ratios. The cost-to-income ratio, widely used in banking, expresses operating costs as a percentage of operating income. A lower ratio indicates greater efficiency. A rising ratio may signal that costs are growing faster than revenues, a trend that, if sustained, will eventually compress profitability. Cost efficiency and cost cutting are related but not identical. Cost cutting reduces spending in the short term but may also reduce capability. Cost efficiency achieves the same or better results with less, a distinction that matters greatly over the long term, and that separates businesses that grow sustainably from those that simply spend less. Cost of capital. The cost of capital is the minimum return that an investor or company requires in order to justify an investment, reflecting the opportunity cost of deploying capital in a particular way rather than in the next best available alternative. Imagine a pool of money with many possible destinations. Each destination, each investment or project, offers a different expected return. The cost of capital is the threshold below which a destination is not worth choosing. It is not a fixed number. It is a rate, the rate that must be exceeded before the deployment of capital is considered worthwhile. For a company, the cost of capital reflects the blended cost of its debt and equity financing. Debt has a cost expressed as an interest rate. Equity has a cost expressed as the return required by shareholders to justify holding the company's shares rather than investing elsewhere. The weighted average of these two costs, based on the proportion each represents in the capital structure, is the weighted average cost of capital, or WACC. Companies use their cost of capital as a benchmark when evaluating potential investments. A project that is expected to return more than the cost of capital creates value. A project that returns less destroys it, even if the absolute return is positive. The cost of capital is not observable directly. It must be estimated, using models and market data and judgment. Different analysts applying different assumptions to the same company may arrive at different figures. The estimate is imprecise. But the concept it represents, the minimum acceptable return on deployed resources, is fundamental to every investment decision made. Cost of debt. The cost of debt is the effective interest rate a company pays on its borrowed funds. It represents the cost of financing through loans, bonds, and other debt instruments, and is typically expressed as an annual percentage. Think of a company that has borrowed money from several sources, a bank loan at one rate, a bond issued to the market at another. Each source of debt carries its own interest obligation. The cost of debt is the weighted average of those rates, reflecting the true ongoing expense of the company's borrowed capital. The cost of debt is lower than the cost of equity for most companies, because debt holders have a senior claim on the company's assets in the event of financial difficulty. They accept a lower return in exchange for this greater security. Interest payments on debt are also typically tax-deductible, which reduces the effective after-tax cost of debt further. In calculating a company's weighted average cost of capital, the cost of debt is adjusted for this tax benefit. If a company pays interest at 5% and the corporate tax rate is 25%, the after-tax cost of debt is 3.75%, the rate that actually affects the company's economics once the tax shield is taken into account. The cost of debt changes with market conditions and with the company's own creditworthiness. A company whose financial position deteriorates will find that new borrowing costs more. A company whose credit improves, or that borrows in a lower interest rate environment, will find that its cost of debt falls. The rate is never permanent. It reflects, at any moment, the current price of the company's financial reputation. Cost of equity. The cost of equity is the return that a company must deliver to its equity investors, its shareholders, in order to justify their continued investment. It represents the opportunity cost of equity capital and is a key component of the weighted average cost of capital. Unlike the cost of debt, which is expressed in a formal interest rate agreed in a contract, the cost of equity is not directly observable. There is no invoice issued. No payment schedule. The shareholders do not send the company a bill for their required return. And yet the cost is real. If the company does not deliver sufficient returns, shareholders will sell their shares, the share price will fall, and the cost of raising new equity will rise. The cost of equity is typically estimated using financial models. The most widely used is the capital asset pricing model, which calculates the expected return on equity as the risk-free rate plus a premium for the specific risk of the company's shares relative to the broader market. A company with shares that tend to move more dramatically than the market as a whole is considered to carry more risk. Investors require a higher return to compensate for that risk. A company whose shares move more steadily carries less risk, and investors require a lower return. The cost of equity is higher than the cost of debt for most companies, because equity holders bear more risk. They are last in line in insolvency, and their returns depend entirely on the company's performance. The higher return they require is the fair price of that position, demanded quietly, through the behavior of markets, without ever being formally stated. Cost of goods sold. Cost of goods sold, commonly abbreviated as COGS, refers to the direct costs attributable to the production of the goods sold by a company during a given period. It includes raw materials, direct labor, and manufacturing overhead, but excludes indirect expenses such as distribution and sales costs. Picture a factory at the end of a production run. Goods have been made. They have been sold. To determine the profit from those sales, the revenue must be compared against the direct costs of producing what was sold. The materials consumed. The wages of the workers on the production floor. The energy used by the machinery. Together, these direct costs are the cost of goods sold. Cost of goods sold is subtracted from revenue to produce gross profit, the most basic measure of how efficiently a company converts its production inputs into value. A company with high revenues but also high cost of goods sold may have a thin gross margin. A company that produces efficiently may retain a larger proportion of each sale as gross profit. Different industries have very different relationships between revenue and cost of goods sold. Manufacturing companies typically have higher COGS relative to revenue than software companies, whose products can be replicated at minimal marginal cost. These structural differences make cross-industry comparisons of gross margin less meaningful than comparisons within the same sector. Cost of goods sold is sensitive to inventory valuation methods. The choice between first in first out, last in first out, or average cost accounting can produce different COGS figures from the same physical inventory, affecting gross profit and, ultimately, reported earnings. Cost of living. The cost of living refers to the amount of money required to maintain a certain standard of living in a given place, covering essential expenses such as housing, food, transportation, healthcare, and other necessities. Think of the recurring financial demands of an ordinary life in a particular city. The rent paid each month for a place to live. The groceries purchased each week. The transport used each day. The healthcare accessed when needed. The accumulated total of these necessary expenditures, measured over a defined period, is the cost of living in that place. Cost of living varies significantly across geographies. A city with expensive housing, high taxes, and costly services will have a higher cost of living than one where accommodation is affordable and daily expenses are modest. These differences affect decisions about where to live, where to work, and how much income is genuinely sufficient. Cost of living adjustments, sometimes abbreviated as COLAs, are used to modify wages, salaries, and benefits to account for changes in the cost of living over time. Many employment contracts, pension arrangements, and government benefits include provisions for automatic adjustment based on inflation measures. Comparisons of cost of living across cities and countries are published regularly by various research organizations. They allow individuals considering a relocation, and companies managing international compensation, to understand the purchasing power implications of living in different locations. A salary that provides comfort in one city may provide very little in another. The number matters less than what it can actually buy. Cost overrun. A cost overrun occurs when the actual costs of a project or activity exceed the initially budgeted or estimated costs. It is a common challenge in large projects, particularly in construction, infrastructure, and technology, and can have significant financial consequences. Picture a project that began with a carefully prepared budget. The estimate was thorough. The contingencies were included. And yet, as work progressed, complications arose. Materials cost more than anticipated. The timeline extended. Scope changed. Additional work was required. The actual cost, as it accumulated month after month, moved steadily beyond the original figure. That movement is the cost overrun. Cost overruns can arise from many sources. Underestimation at the planning stage, whether through optimism, insufficient analysis, or deliberate underreporting to secure approval, is one of the most common. Changes in scope, unforeseen technical challenges, supply chain disruptions, and poor project management can all contribute. Research by academics such as Bent Flyvjerg has found that large infrastructure projects systematically overrun their budgets across countries and across decades. The pattern is so consistent that it has been described as an iron law of megaprojects. They are over budget, over time, over and over again. The financial consequences of a significant cost overrun can be severe. Projects may require additional financing. Contracts may become the subject of disputes. The returns originally projected may never materialize. Prevention requires rigorous planning, honest estimation, disciplined oversight, and the willingness to stop or modify a project when its economics have fundamentally changed. Cost-push inflation. Cost-push inflation is a type of inflation that occurs when the costs of production rise, typically due to increases in wages, raw material prices, or energy costs, and producers pass those higher costs on to consumers through higher prices. Think of a chain of costs, each one linked to the next. The price of oil rises. The cost of transporting goods rises. The cost of manufacturing rises. The cost of the finished product rises. The consumer, at the end of the chain, pays more, not because they are demanding more, but because the cost of supplying what they demand has increased. This is cost-push inflation, prices rising from the supply side. Cost-push inflation is distinct from demand-pull inflation, which occurs when consumers demand more goods and services than the economy can produce, pulling prices upward from the demand side. In practice, both forces often operate simultaneously, making it difficult to isolate the precise cause of a given inflationary episode. Cost-push inflation poses a particular challenge for central banks. The standard response to inflation, raising interest rates, reduces demand and can ease demand pull pressures. But raising rates does not reduce the cost of oil or the price of commodities. It may slow the economy without addressing the underlying cause of the price rise, creating a difficult trade-off between controlling inflation and supporting growth. The oil price shocks of the 1970s are the most frequently cited historical examples of cost-push inflation. They demonstrated that supply-side disruptions can generate persistent price increases that are difficult to resolve through conventional monetary tools alone. Counterparty. A counterparty is the other party in a financial transaction or contract. In any agreement, a loan, a trade, a derivative contract, an insurance policy, there are at least two parties. The counterparty is whoever is on the other side of the arrangement from the perspective of the party considering the transaction. Think of a handshake. Two hands meet. From the perspective of each person, the other is the counterparty, the party with whom the agreement has been made, on whom the terms of the contract will depend, and whose performance will determine whether the transaction is completed as agreed. In financial markets, the concept of the counterparty is fundamental. When an investor buys a bond, the issuer of the bond is the counterparty. When a bank enters into a derivative contract, the institution on the other side is the counterparty. When an insurance policy is purchased, the insurer is the counterparty to the policyholder's claim. The identity and financial strength of the counterparty matters because agreements create mutual obligations. If a counterparty fails to meet its obligations, if it defaults, becomes insolvent, or is otherwise unable to perform, the other party to the agreement may suffer a loss. This is known as counterparty risk. Financial institutions monitor and manage their counterparty exposures carefully, assessing the creditworthiness of those with whom they transact and setting limits on the concentration of exposure to any single entity. Behind every transaction, however routine, is a counterparty, and with the counterparty comes a degree of dependency that is always present, even when it is rarely considered. Counterparty risk. Counterparty risk is the risk that the other party in a financial transaction will fail to fulfill their contractual obligations, either by defaulting on a payment, failing to deliver an asset, or otherwise not performing as agreed. Imagine a contract signed between two institutions. Each has made commitments to the other. One will deliver payment. The other will deliver securities. On the settlement date, everything proceeds as agreed. But what if one party is unable to perform? What if, between the signing of the contract and its settlement, the financial condition of one party deteriorates to the point where it can no longer meet its obligations? That possibility is counterparty risk. Counterparty risk is inherent in virtually all financial transactions. It is most significant in over-the-counter derivative contracts, where agreements are made directly between parties without a central clearing house to guarantee performance. In these transactions, each party is exposed to the credit risk of the other for the full duration of the contract. Methods for managing counterparty risk include requiring collateral, setting credit limits, using netting agreements, and routing transactions through central clearing counterparties. Each of these measures reduces the potential loss in the event of a counterparty default. The global financial crisis of 2008 brought counterparty risk to wide attention. The interconnected web of derivative exposures between major financial institutions created a situation in which the failure of one institution threatened the stability of many others. The lesson embedded in that experience has shaped financial regulation and risk management practices in the years since. Coupon rate. The coupon rate is the annual interest rate paid by the issuer of a bond to the bondholder, expressed as a percentage of the bond's face value. It determines the periodic interest payments made throughout the life of the bond. Think of a bond as a formal promise, printed on a document and accompanied by a schedule of payments. The coupon rate is the rate specified in that schedule. A bond with a face value of $1,000 and a coupon rate of 5% will pay $50 in interest each year, typically in two semi-annual payments of $25 each, for as long as the bond remains outstanding. The term coupon originates from the practice, now largely historical, of issuing physical bond certificates with attached coupons. Bondholders would physically clip a coupon and present it to the issuer to receive each interest payment. The coupons gave their name to the payment itself, and the name has remained even as the paper has disappeared. The coupon rate is fixed at the time of issuance and does not change over the life of the bond. What changes is the bond's price in the secondary market. When interest rates rise above the coupon rate, the bond's price falls below its face value, making its effective yield higher. When interest rates fall below the coupon rate, the price rises above face value, and the effective yield falls. The coupon rate is the most visible number associated with a bond. But it is not the most important one. The yield, which reflects the coupon rate, the price paid, and the time remaining to maturity, is the figure that determines what the investor actually earns. Covenant. In finance, a covenant is a condition or restriction included in a loan agreement or bond indenture that the borrower must comply with throughout the life of the debt. Covenants are designed to protect the interests of the lender by limiting the borrower's behavior in specified ways. Picture a lending agreement, many pages long, setting out not only the terms of repayment but also a set of ongoing obligations. The borrower must maintain certain financial ratios. They must not take on additional debt beyond a specified amount. They must not sell major assets without consent. They must provide regular financial reports. Each of these obligations is a covenant, a condition attached to the privilege of the loan. Covenants fall into two broad categories. Positive covenants, also called affirmative covenants, require the borrower to take specific actions, maintaining insurance, filing financial statements, or preserving the assets that serve as collateral. Negative covenants, or restrictive covenants, prohibit specific actions, taking on excessive additional debt, paying dividends above a certain level, or making large acquisitions. Financial covenants set specific numerical thresholds, minimum levels of liquidity, maximum leverage ratios, or minimum interest coverage requirements. If these thresholds are breached, a technical default is triggered, giving the lender the right to demand immediate repayment or renegotiate the terms. Covenants are the quiet architecture of the lender-borrower relationship, the terms that operate in the background throughout the life of a loan, ensuring that the conditions under which credit was extended continue to be met, or that the lender is alerted promptly when they are not. Covered call. A covered call is an option strategy in which an investor who holds a long position in an asset sells a call option on that same asset. It generates income from the option premium while limiting the potential upside if the asset's price rises above the option's strike price. Think of an investor who owns 100 shares of a company. The shares are held in a portfolio. The investor does not expect the price to rise dramatically in the near term. Rather than simply holding the shares and waiting, the investor sells someone else the right to buy those shares at a specified price, say, 10% above the current market price, within a defined period. In exchange for selling that right, the investor receives a premium. That premium is income, received today, in exchange for capping potential future gains. The covered call is considered a relatively conservative option strategy because the call sold is covered, the investor already owns the underlying shares. If the option is exercised, the investor simply delivers the shares they hold. There is no need to purchase them at market price to fulfill the obligation. The trade-off is straightforward. The investor receives income through the premium. But if the share price rises above the strike price, the shares will be called away, and the investor will not participate in that upside. The premium received provides some cushion against a decline, but does not protect against a significant fall. Covered calls are commonly used by investors who wish to generate additional income from existing holdings, particularly in sideways or modestly rising markets where strong capital appreciation is not expected in the short term. Credit. Credit, in its most fundamental sense, refers to the ability to borrow money or access goods and services on the understanding that payment will be made in the future. It is an arrangement based on trust. The creditor extends resources now, on the expectation that they will be repaid later. Think of the simple act of handing something of value to another person, not in exchange for immediate payment, but on the basis of an agreement that payment will follow. The exchange is complete. The value has moved. But the settlement has not yet occurred. That gap, between the delivery of value and the receipt of payment, is the space in which credit operates. Credit is one of the oldest and most fundamental mechanisms in economic life. It allows individuals to make purchases before they have accumulated the necessary savings. It allows businesses to invest in growth before they have generated the revenues to fund it. It allows governments to finance expenditure in excess of current tax revenues. The extension of credit is not unconditional. It depends on an assessment of the borrower's ability and willingness to repay. This assessment considers the borrower's income, assets, existing obligations, and financial history. The outcome of the assessment determines whether credit is extended, on what terms, and at what cost. Credit exists in an enormous variety of forms: personal loans, mortgages, credit cards, corporate bonds, sovereign debt, trade credit between businesses. In all of its forms, the basic structure is the same: a transfer of value today, accompanied by a promise to repay tomorrow, sustained by the trust between the parties and, ultimately, by the law. Credit Bureau. A credit bureau is an organization that collects and maintains financial information about individuals and businesses, compiling records of their borrowing history and repayment behavior, and providing this information to lenders as credit reports. Picture a vast and meticulously maintained archive. For each individual with a credit history, there is a file. The file records every credit account opened, every payment made on time, every payment missed, every inquiry from a lender, and every public financial event, bankruptcies, judgments, and similar matters. When a lender wishes to assess a prospective borrower, they consult this archive. The file they receive is the credit report. Credit bureaus, also known as credit reference agencies, operate as intermediaries in the credit market. By aggregating repayment data from many lenders, they provide a consolidated picture of a borrower's financial behavior, information that no single lender could compile on their own. In most countries, a small number of major credit bureaus dominate the market. In the United States, the three largest are Equifax, Experian, and TransUnion. Their data feeds into the credit scores that determine the terms on which individuals can borrow. Credit bureaus are regulated in most jurisdictions. Individuals typically have the right to access their own credit report and to dispute inaccuracies. The data held about a person can significantly affect their financial opportunities, and the accuracy of that data therefore matters considerably. It sits quietly in a file, updated with each transaction, shaping financial possibilities without ever announcing itself. Credit card. A credit card is a payment card issued by a financial institution that allows the cardholder to borrow funds up to a pre-approved limit in order to pay for goods and services. The borrowed amount must be repaid, typically within a monthly billing cycle, with interest charged on any balance carried beyond the payment due date. Think of a small piece of plastic held in a wallet. It does not contain money. It contains access, access to a line of credit extended by a financial institution, available at the point of any transaction where the card is accepted. The cardholder spends. The statement arrives. The choice is made to repay in full, avoiding interest, or to carry a balance and incur the charge. Credit cards offer convenience and flexibility. They allow purchases to be made without carrying cash. They provide a short-term, interest-free loan for purchases repaid within the billing cycle. They often include additional benefits such as purchase protection, reward points, and fraud insurance. However, credit card debt, when not managed carefully, can become expensive and persistent. Interest rates on unpaid credit card balances are typically high, significantly higher than most other forms of consumer credit. A balance that compounds at high interest and is repaid only in minimum monthly amounts can take years to clear and cost considerably more than the original purchases. The credit card is one of the most widely used financial instruments in the world. Its convenience is genuine. Its costs, when it is not used carefully, are equally real. The two exist together, in the same small card, available for use at any moment. Credit crunch. A credit crunch is a sudden and severe reduction in the availability of credit, or a sharp increase in the cost of obtaining credit, across an economy. It occurs when lenders significantly tighten their lending standards or reduce lending activity, often in response to financial stress or uncertainty. Imagine a network of pipes through which credit normally flows freely, from banks to businesses, from lenders to households, from institutions to one another. In a credit crunch, many of those pipes narrow sharply or close entirely. The flow of credit slows. Projects that would have been funded are not. Businesses that would have expanded cannot. Households that expected to borrow find the terms have changed, or find that credit is no longer available at all. Credit crunches typically arise during periods of financial stress. Banks that have experienced losses become more cautious. Uncertainty about the creditworthiness of borrowers increases. The willingness to extend credit declines, sometimes rationally, sometimes beyond what the underlying conditions justify, and a self-reinforcing cycle can develop. The credit crunch of 2007 and 2008 was one of the most severe in modern economic history. It began in the subprime mortgage market in the United States, spread to the broader banking system, and resulted in a near freezing of credit markets globally. Central banks and governments intervened on an unprecedented scale to restore the flow of credit. A credit crunch is one of the most economically damaging events a modern economy can experience. Credit, once withdrawn, can take a very long time to return to normal levels. The effects on investment, employment, and growth can persist for years after the initial disruption has passed. Credit default swap. A credit default swap, commonly abbreviated as CDS, is a financial derivative contract in which one party, the protection buyer, pays a regular fee to another party, the protection seller, in exchange for compensation if a specified borrower defaults on its obligations. Think of an insurance policy, though the legal structure is different. One party pays a regular premium. In exchange, the other party agrees that if a defined credit event occurs, typically the default of a bond issuer or borrower, compensation will be paid. The protection buyer is protected against the loss. The protection seller has accepted the risk. Credit default swaps allow investors to manage or transfer credit risk without needing to buy or sell the underlying bonds. A bank that has lent money to a corporation can purchase a CDS to hedge its exposure. A speculative investor who believes a company is likely to default can buy a CDS without owning any of the company's debt. Credit default swaps became widely known during the 2008 financial crisis, when the scale of CDS exposure across the financial system became apparent. American International Group, or AIG, had sold enormous quantities of credit protection and was unable to meet its obligations when the instruments it had protected began to fail. The resulting government rescue was one of the largest in financial history. The CDS market is large and complex. Contracts are traded privately between institutions, with limited transparency. It is a market that operates largely out of public view, a system of financial arrangements, each one quiet and bilateral, whose aggregate effect became visible only during a crisis. Credit enhancement. Credit enhancement refers to strategies or structures used to improve the credit quality of a financial instrument or a borrower's obligations, making them more attractive to investors or lenders by reducing the perceived risk of default or loss. Picture a document that, on its own, carries a certain level of risk. The terms are clear. The obligations are defined. But a lender reviewing the document is uncertain. The risk is higher than they are comfortable with. Credit enhancement is the addition of a further element to that document, a guarantee, reserve fund, or a structural feature, that reduces the risk to a level the lender is prepared to accept. Credit enhancement takes many forms. External credit enhancement includes third-party guarantees, letters of credit, or bond insurance, in which a financially stronger entity commits to covering losses if the primary obligor fails. Internal credit enhancement includes structural features within a transaction itself, such as over-collateralization, where the value of the assets backing a security exceeds the value of the obligations it supports. In securitization, credit enhancement is used to allow pools of lower quality assets to support securities that achieve investment-grade ratings. By adding layers of protection, subordination, reserve accounts, excess spread, the most senior securities can be insulated from losses that might affect the overall pool. Credit enhancement is a tool for making transactions possible that might otherwise not occur. It bridges the gap between what a borrower can offer and what a lender requires, quietly, structurally, through the careful arrangement of obligations and protections. Credit exposure. Credit exposure is the maximum potential loss that a lender or investor would face if a borrower or counterparty were to default on their obligations. It represents the amount of financial risk attributable to a single credit relationship or position. Think of a financial institution that has lent money to several borrowers, purchased bonds from several issuers, and entered into derivative contracts with several counterparties. For each of these relationships, there is an amount at risk, the amount that would be lost if the other party were to fail. That amount is the credit exposure to that party. Credit exposure can be straightforward in the case of a loan. A bank that has lent $1 million to a borrower has a credit exposure of up to $1 million, reduced by the value of any collateral held. The calculation is direct. In derivative contracts, credit exposure is more complex. The amount at risk depends on the current value of the contract, which fluctuates with market prices, as well as the potential for that value to change further over the remaining life of the contract. This potential future exposure must be estimated using statistical models. Financial institutions monitor their credit exposures continuously. They set limits on the maximum exposure permitted to any single borrower, counterparty, industry, or geography. When exposure approaches a limit, action is required, reducing positions, seeking collateral, or obtaining hedges. The management of credit exposure is one of the most fundamental disciplines in banking, conducted constantly, in the background of every transaction. Credit facility. A credit facility is a formal agreement between a financial institution and a borrower that establishes a defined amount of credit available for use over a specified period. Unlike a single loan, a credit facility can typically be drawn upon, repaid, and drawn upon again, providing flexible access to funds as needed. Imagine a reservoir connected to a property by a pipe with a valve. The reservoir holds a defined volume of water. The property owner may open the valve and draw from the reservoir when water is needed, and close it when the immediate need has passed. The water drawn is replenished over time. The facility, the agreement that provides access to the reservoir, remains in place for the duration of the arrangement. Credit facilities take many forms. A revolving credit facility allows borrowing up to a set limit, repayment in full or in part, and repeated borrowing. A term loan facility provides a lump sum for a defined period. A standby credit facility is available for use in specific circumstances, such as a bridge to long-term financing or a contingency against unexpected needs. Credit facilities are used by companies to manage working capital, fund seasonal fluctuations in activity, support acquisitions, or simply provide a financial cushion. Large corporations often maintain revolving credit facilities with consortia of banks, providing a backstop of liquidity that may never be fully drawn but is reassuring in its availability. The terms of a credit facility, the interest rate, the fees, the covenants, the availability period, are negotiated between the borrower and the lender. Once agreed, the facility sits in place, available but not compulsory, ready to be used precisely when it is required. Credit freeze. A credit freeze, also known as a security freeze, is a tool that individuals can use to restrict access to their credit report, preventing new credit accounts from being opened in their name without explicit authorization. It is most commonly used as a measure to protect against identity theft. Picture a file cabinet containing a comprehensive record of a person's financial history. Normally, any lender who receives an application for credit can request access to that file. A credit freeze places a lock on the cabinet. Requests for access are denied unless the individual provides specific authorization. A new credit card cannot be issued. A new loan cannot be approved. The lock protects the file from those who would attempt to use it without permission. Credit freezes are available in most jurisdictions where consumer credit reports are maintained. Placing and lifting a freeze is typically free of charge and can be done through the major credit bureaus. When the individual wishes to apply for new credit themselves, they temporarily lift the freeze, allowing the application to proceed. A credit freeze does not affect an existing credit score or prevent the use of existing credit accounts. It simply prevents new accounts from being opened in the person's name without their knowledge and consent. Following significant data breaches in recent years, credit freezes have become more widely used and more widely discussed. They represent a quiet but effective form of financial self-protection, a decision made in a moment of caution, whose benefit may never need to be tested. Credit line. A credit line, also referred to as a line of credit, is a flexible borrowing arrangement that provides a borrower with access to a specified maximum amount of funds, which can be drawn upon, repaid, and drawn upon again as needed. Interest is charged only on the amount actually borrowed, not on the total available credit. Think of a number written at the top of a page. That number represents the maximum that can be borrowed. Below it, the actual amount currently in use, which may be zero, or may be some portion of the maximum, depending on current needs. The credit line is the arrangement that makes this flexibility possible. Credit lines are available to both individuals and businesses. A personal line of credit or home equity line of credit gives individuals flexible access to funds for personal expenses, home improvements, or other purposes. A business line of credit provides working capital for operational needs, managing payroll during a slow period, covering inventory purchases ahead of seasonal demand, or bridging gaps between invoicing and payment. The cost of a credit line typically includes an interest rate applied to the outstanding balance and may also include a commitment fee for maintaining the availability of the undrawn portion. The terms vary depending on the borrower's creditworthiness and the policies of the lender. A credit line is most valuable as a buffer, available when needed, quiet when not. Its presence provides financial flexibility without requiring the full commitment of a fixed loan. The unused portion costs relatively little. The used portion is repaid and becomes available again. It is one of the more quietly useful arrangements in personal and corporate finance. Credit migration. Credit migration refers to the movement of a borrower's credit rating from one level to another over time, either an upgrade, indicating improved creditworthiness, or a downgrade, indicating deterioration. It is a key concept in credit risk analysis. Picture a scale with many gradations, ranging from the highest quality at the top to the lowest at the bottom. A borrower or bond issuer is placed at a position on this scale. Credit migration describes the movement of that position over time, upward when conditions improve, downward when they worsen. The movement itself is the migration. Credit rating agencies, including Moody's, Standard & Poor's, and Fitch, assign credit ratings to issuers and their obligations and revise those ratings as circumstances change. An upgrade typically leads to a reduction in borrowing costs, as investors become willing to accept lower yields for a borrower they now consider safer. A downgrade has the opposite effect. Credit migration is studied using transition matrices, statistical tables that record the historical probability of a rated entity moving from any given rating to any other within a specified period. These matrices inform the credit risk models used by banks, insurers, and investment managers. For investors in fixed-income securities, credit migration is a source of both risk and opportunity. A downgrade can reduce the market value of a bond, even if no default has occurred. An upgrade can increase it. The careful monitoring of credit migration, watching the scale and noting any movement, is part of the ongoing discipline of managing a portfolio of credit exposures. Credit rating. A credit rating is an assessment of the creditworthiness of a borrower, whether an individual, a corporation, or a sovereign government, expressed as a grade or classification that indicates the likelihood of the borrower meeting its financial obligations. Think of a report card for financial behavior. The assessment considers the borrower's financial history, current financial position, the nature of its obligations, and the economic environment in which it operates. The result is a grade, a letter or combination of letters that summarizes, in a single symbol, the evaluator's assessment of credit risk. Credit ratings are assigned by specialist agencies. Moody's, Standard & Poor's, and Fitch are the three largest. Each uses its own scale. Standard & Poor's highest rating is AAA, assigned to borrowers considered to have the lowest possible credit risk. Ratings decline through AA, BBB, the lowest investment grade level, and then into sub-investment grade, or high-yield, territory. Credit ratings affect the cost of borrowing. A borrower with a high rating can typically borrow at a lower interest rate, because investors are confident in repayment and require less compensation for risk. A borrower with a lower rating must pay more, reflecting the greater uncertainty around their ability to repay. Credit ratings are opinions, not guarantees. They can be wrong, and in prominent cases, most visibly during the 2008 financial crisis, they have been wrong in ways that had significant consequences. They remain, nonetheless, a fundamental reference point in credit markets, a shared language for discussing risk, imperfect but widely understood. Credit score. A credit score is a numerical expression of a person's creditworthiness, derived from an analysis of their credit history. It is used by lenders to quickly assess the risk of extending credit to a particular individual. Picture a single number, typically ranging from 300 to 850, depending on the scoring model, that attempts to distill an individual's entire financial history into a compact and comparable form. The number does not tell the full story, but it provides an immediate, standardized measure that allows lenders to make consistent assessments across large volumes of applicants. Credit scores are calculated using algorithms that weigh several factors. Payment history, whether bills have been paid on time, is the most significant. Also considered are the total amount of debt outstanding, the length of the credit history, the types of credit used, and the number of recent applications for new credit. A higher credit score indicates lower perceived risk and typically results in more favorable lending terms, lower interest rates, higher credit limits, and better conditions. A lower score may result in higher rates, reduced access to credit, or outright rejection of an application. Credit scores can change over time, rising with consistent repayment and responsible borrowing behavior, or falling following missed payments, high utilization of available credit, or the accumulation of debt. They are dynamic, a reflection of ongoing financial behavior rather than a fixed assessment. The number improves or deteriorates based on what the person does, month after month, one quiet transaction at a time. Credit spread. A credit spread is the difference in yield between two bonds of similar maturity but different credit quality, most commonly, the difference between a corporate bond yield and the yield on a comparable government bond. It represents the additional return investors demand for accepting credit risk. Think of two roads running side by side. One is a government road, well maintained, rarely subject to disruption, guaranteed to remain open. The other is a corporate road, equally well built in normal conditions, but subject to greater uncertainty. The credit spread is the premium charged for traveling on the corporate road, the additional cost of accepting the possibility that conditions may deteriorate. When a corporate bond offers a yield of 5% and a government bond of the same maturity offers 3%, the credit spread is 2 percentage points, or 200 basis points. That spread is the market's estimate of the compensation required for bearing the additional credit risk of the corporate issuer. Credit spreads widen when investors become more risk-averse, demanding greater compensation for uncertainty. They tighten when confidence is high and investors are willing to accept less additional yield for the same risk. Movements in credit spreads are closely watched as indicators of market sentiment and financial conditions. During periods of financial stress, credit spreads can widen dramatically and rapidly. The spread reflects not just the risk of the specific issuer, but the general mood of the credit market. In calm conditions, spreads narrow. In uncertainty, they expand. The spread is always there, measuring the distance between certainty and risk. Credit union. A credit union is a member-owned, not-for-profit financial cooperative that provides banking services, including savings accounts, loans, and payment services, to its members. Unlike commercial banks, credit unions return their profits to members in the form of lower fees, higher interest on savings, and lower rates on loans. Think of a financial institution that belongs to its customers, or rather, its members. Each person who opens an account becomes a part owner of the organization. The institution does not seek to generate profit for external shareholders. Its purpose is to serve its members, and any surplus generated is directed back to them. Credit unions are typically formed around a common bond, a shared employer, profession, community, or other affiliation that defines the membership. The largest credit unions in the United States serve millions of members, while smaller ones may serve a single employer's workforce. The not-for-profit structure of credit unions allows them to offer competitive rates that many commercial banks do not match. Because they are not required to generate returns for shareholders, they can pass more of their income to members. This is particularly apparent in lending rates for personal loans and mortgages, and in the fees charged for basic banking services. Credit unions are regulated, though in many countries under a different framework from commercial banks. Their deposits are typically insured by a government-backed scheme in the same way as bank deposits. They are one of the quieter corners of the financial system, less visible than the large commercial banks, but serving their members with a consistency that has sustained the model for well over a century. Crowdfunding. Crowdfunding is the practice of raising money for a project, business, or cause by soliciting small contributions from a large number of people, typically via an online platform. It allows individuals and organizations to access capital without relying on traditional financial intermediaries. Picture a public square. In the center stands a person with an idea, an invention, a creative project, a community initiative, a new business. Around them stand many others, each carrying a small amount. The person explains their idea. Some of those around them choose to contribute. Individually, each contribution is modest. Together, they fund the project. That, in essence, is crowdfunding. Crowdfunding takes several forms. Reward-based crowdfunding offers contributors a product, experience, or acknowledgement in exchange for their support. Equity crowdfunding offers a small ownership stake in the business being funded. Debt-based crowdfunding, or peer-to-peer lending, provides contributors with a return through interest payments. Donation-based crowdfunding asks for contributions without any material return. Platforms such as Kickstarter, Indiegogo, and GoFundMe have made crowdfunding accessible to a wide range of projects and causes. The model has funded films, consumer products, charitable initiatives, and early-stage businesses that might not have attracted conventional financing. Crowdfunding is not without risk. Many projects fail to deliver on their promises. Equity crowdfunding investments can lose their entire value. Regulation of the sector has evolved as it has grown. But for the right project, in the right circumstances, it represents an alternative path to capital, wide, distributed, and built on the collective willingness of many to believe in something not yet fully formed. Crowding out. Crowding out is the economic phenomenon in which increased government borrowing leads to higher interest rates, which in turn reduces private sector investment. By competing with private borrowers for available funds, government borrowing effectively displaces, or crowds out, private spending and investment. Think of a room with a fixed number of chairs. When the government takes more chairs to accommodate its own guests, fewer are available for private visitors. Some private visitors find nowhere to sit and leave. The government's presence has reduced the space available for others. In financial markets, the chairs are the available pool of savings and loanable funds. When a government runs a large budget deficit, it must borrow to fund the gap. This increased demand for borrowed funds pushes up interest rates, the price of borrowing, across the economy. As rates rise, private investment projects that were viable at lower rates become less attractive. Businesses invest less. Households borrow less. The stimulus provided by government spending is partially offset by the reduction in private activity. The extent of crowding out is debated among economists. In a recession, when private sector demand for funds is weak, the government may be able to borrow significantly without driving rates higher, because it is borrowing funds that were not otherwise being used productively. In a growing economy, the effect may be more pronounced. Crowding out is one of the core arguments made against expansionary fiscal policy, the concern that government spending, while boosting demand directly, simultaneously constrains the private investment that drives long-term productive growth. Currency. Currency is the system of money in general use in a particular country or economic area, the medium of exchange accepted for the settlement of transactions, the payment of debts, and the measurement of value within that system. Think of a shared language. Within a community, everyone agrees to communicate using the same words. The words have no intrinsic value, they are simply sounds and symbols, but their shared acceptance gives them meaning and utility. Currency works in the same way. A banknote has no intrinsic value. Its value derives entirely from the collective agreement to accept it. Currencies are issued and managed by central banks or monetary authorities. Their value is maintained through the policies of those institutions, which control the money supply and set interest rates in pursuit of price stability and economic objectives. Exchange rates express the value of one currency relative to another. These rates fluctuate continuously, reflecting differences in economic performance, interest rates, inflation, capital flows, and market sentiment between countries. The exchange rate between two currencies is one of the most widely observed numbers in international finance. Historically, currencies were backed by physical commodities, most commonly gold. Under the gold standard, a currency's value was directly linked to a specified quantity of gold. Most economies abandoned this system in the 20th century, moving to fiat currencies, currencies whose value is not backed by any physical commodity, but is maintained by the authority and credibility of the issuing government and central bank. That credibility, once established, allows an economy to function. Once lost, it is very difficult to restore. Currency appreciation. Currency appreciation refers to an increase in the value of one currency relative to another in the foreign exchange market. When a currency appreciates, it can purchase more of a foreign currency than it previously could. Think of a scale balance between two currencies. When one side rises, when one currency becomes more valuable relative to the other, it has appreciated. The holders of that currency can now exchange it for more of the other. Goods priced in the foreign currency have become, in relative terms, cheaper to buy. Currency appreciation is driven by a range of factors. Higher interest rates in a country tend to attract foreign capital, increasing demand for the currency and pushing its value higher. Strong economic performance, low inflation, and a trade surplus can all contribute to appreciation. Investor confidence in a country's political stability and institutional quality also plays a role. For exporters in an appreciating currency country, appreciation can be challenging. Their goods become more expensive for foreign buyers, potentially reducing demand. Domestic consumers, however, benefit, imported goods become cheaper, and overseas travel becomes more affordable. Currency appreciation and depreciation are relative movements. A currency appreciates against one currency while possibly depreciating against another, depending on the specific dynamics of each bilateral relationship. The foreign exchange market moves continuously, adjusting the relative values of the world's currencies in response to economic data, policy decisions, and the collective judgments of millions of participants acting simultaneously. Currency crisis. A currency crisis occurs when the value of a country's currency falls sharply and rapidly, often in a disorderly way, undermining confidence in the currency and the economy and triggering a broader financial and economic disruption. Imagine a currency that has held a steady value for many years. Investors and businesses have planned around that stability. Then, over a period of days or weeks, confidence in the currency collapses. Investors sell it rapidly. Its value falls sharply against other currencies. The government's attempts to defend it exhaust its foreign reserves. The currency continues to fall. What was stable is suddenly, visibly, not. Currency crises can arise from a variety of circumstances. Unsustainable current account deficits, excessive government debt, high inflation, weak banking systems, or overvalued exchange rates can all create vulnerabilities. When investors collectively conclude that a currency cannot maintain its value, the resulting loss of confidence can become self-fulfilling. Notable currency crises include the collapse of the Mexican peso in 1994, the Asian financial crisis of 1997, the Russian crisis of 1998, and the Argentine crisis of 2001. Each had different origins but shared a common pattern: a sudden and severe loss of confidence, a sharp currency depreciation, and significant economic consequences for the affected country. A currency crisis rarely stays contained within financial markets. It affects the real economy, raising the cost of imports, increasing the burden of foreign currency debt, and disrupting the economic plans of individuals and businesses across the country. The effects can last for years after the immediate crisis has passed. Currency devaluation. Currency devaluation is a deliberate downward adjustment in the value of a country's currency relative to other currencies, made by the country's government or central bank. It is typically used to improve export competitiveness or reduce trade deficits. Think of a price tag being changed, not by the market, but by a deliberate decision. The country's currency is officially declared to be worth less than it was before. Goods exported from the country now cost less to foreign buyers. Imports into the country now cost more. The adjustment is intentional and designed to produce specific economic effects. Devaluation is most commonly associated with countries operating under a fixed or managed exchange rate regime, in which the government maintains the currency's value within a defined band. When the maintained level becomes unsustainable, typically because it is overvalued relative to economic fundamentals, a formal devaluation may be announced. The potential benefits of devaluation include improved export competitiveness and a reduction in trade deficits. If a country's goods become cheaper for foreign buyers, demand for exports may increase. Domestic industries facing competition from imports may also benefit as imported goods become more expensive. However, devaluation also carries risks. It increases the cost of imports, including raw materials and energy, which can push inflation higher. It increases the burden of foreign currency debt. And it can trigger a loss of investor confidence if it is perceived as a signal of deeper economic weakness. Devaluation is a tool, but one whose effects are not entirely within the control of those who use it. Currency forward. A currency forward is a contract to exchange a specified amount of one currency for another at a predetermined exchange rate on a future date. It is used primarily to hedge against the risk of exchange rate movements. Picture a business that will receive a payment in a foreign currency in 3 months' time. The business does not know what the exchange rate will be at that point. If the foreign currency weakens, the payment will be worth less in domestic terms than expected. To eliminate this uncertainty, the business enters into a currency forward, an agreement to sell the foreign currency at today's agreed rate, regardless of what the market rate is when the payment arrives. Currency forwards are private contracts agreed directly between two parties, typically a business and a bank. They are not standardized or traded on an exchange. The terms are negotiated to meet the specific needs of the parties involved, including the amount, the currencies, the exchange rate, and the settlement date. Unlike currency options, which give the holder the right but not the obligation to exchange currencies at a specified rate, a forward contract is binding on both parties. The exchange will occur at the agreed rate, regardless of how market rates have moved in the meantime. Currency forwards are among the most widely used hedging instruments in international commerce. They allow businesses to plan with certainty, budgeting and pricing their activities without exposure to the unpredictability of foreign exchange markets. The rate is locked in advance. The uncertainty is resolved at the moment the contract is signed. Currency futures. Currency futures are standardized contracts traded on exchanges that obligate the buyer to purchase, and the seller to deliver, a specified amount of one currency in exchange for another at a predetermined price on a set future date. Think of a currency forward, but standardized and traded publicly. The contract size is fixed. The delivery dates are fixed. The rules governing the transaction are set by the exchange. Buyers and sellers come together in a regulated market rather than in a private bilateral arrangement. That is the currency futures market. Currency futures serve the same fundamental purpose as currency forwards, allowing businesses, investors, and financial institutions to lock in exchange rates for future transactions. However, their standardized, exchange-traded nature makes them more accessible and more liquid than forwards, and introduces a central clearing counterparty that reduces counterparty risk. Positions in currency futures are marked to market daily. This means that gains and losses on open positions are settled each day based on the closing price, rather than accumulating until the contract's maturity. Margin must be maintained to cover any adverse movements. This daily settlement process ensures that losses do not accumulate to a size that cannot be met. Currency futures are used by importers and exporters to manage transaction risk, by investors to gain or hedge foreign currency exposure, and by speculators who anticipate movements in exchange rates. The contracts trade on exchanges such as the Chicago Mercantile Exchange, quietly and continuously, as long as markets are open. Currency hedging. Currency hedging is the use of financial instruments to reduce or eliminate the risk of losses arising from fluctuations in exchange rates. It is employed by businesses, investors, and institutions with exposure to foreign currencies. Think of an umbrella. It does not prevent rain. It does not change the weather. It simply ensures that the person holding it arrives at their destination without being soaked, regardless of what the sky decides to do. Currency hedging is the financial equivalent, a protection against exchange rate movements that may or may not occur, but whose impact, if unmanaged, could significantly affect financial outcomes. Companies that operate internationally are naturally exposed to currency risk. A business that manufactures in one country and sells in another faces the possibility that the currency in which it earns revenue will weaken relative to the currency in which it incurs costs. A hedge removes or reduces that exposure. Common hedging instruments include currency forwards, futures, options, and swaps. Each offers a different combination of protection, flexibility, and cost. A forward or future locks in an exchange rate with certainty but eliminates any benefit from favorable rate movements. A currency option provides protection against adverse movements while preserving the ability to benefit if rates move favorably, in exchange for the payment of a premium. Hedging is not speculation. It is the management of existing risk, the deliberate reduction of uncertainty in exchange for the certainty of a known outcome. The hedge may cost money directly, through fees and premiums, or indirectly, through the forfeiture of potential gains. The cost is accepted in exchange for the predictability that, for many purposes, is worth more. Currency peg. A currency peg is a policy in which a country's monetary authority fixes its exchange rate to the currency of another country, or to a basket of currencies, rather than allowing it to float freely in the market. Think of a boat tied to a dock. The water moves. The tide comes in and goes out. But the boat remains at the same position relative to the dock, because the rope holds it there. A currency peg is that rope, the mechanism by which a country's exchange rate is held to a fixed point, regardless of the natural movements that market forces might otherwise produce. Countries adopt currency pegs for a variety of reasons. A peg provides exchange rate stability, which can reduce uncertainty for businesses and investors engaged in international trade. It can also anchor inflation expectations, particularly if the currency is pegged to one with a strong track record of price stability. Maintaining a peg requires the central bank to intervene actively in the foreign exchange market. When demand for the domestic currency falls and its value would naturally decline, the central bank must buy the domestic currency and sell foreign reserves to maintain the fixed rate. This requires substantial foreign reserve holdings. A currency peg can come under severe pressure if the fixed rate diverges significantly from what market forces would imply. Speculative attacks, in which investors sell the pegged currency en masse, betting that the peg will break, have forced several notable currency devaluations in history. The Hong Kong dollar's peg to the US dollar, maintained since 1983, is one of the most durable examples. Most pegs, however, are temporary arrangements, lasting only as long as the economic conditions that made them feasible continue to hold. Currency risk. Currency risk, also known as exchange rate risk or foreign exchange risk, is the potential for financial loss arising from changes in the value of one currency relative to another. It affects any individual, business, or institution with financial transactions, assets, or liabilities denominated in a foreign currency. Think of a balance sitting on a scale. On one side is an asset or obligation denominated in a foreign currency. On the other side is the domestic equivalent. The scale is not fixed. As exchange rates move, the domestic value of the foreign position rises or falls, even though the foreign currency amount has not changed. That movement, the potential for gain or loss from exchange rate fluctuations, is currency risk. Currency risk arises in many contexts. A company that sells goods in a foreign market earns revenue in a foreign currency. If that currency weakens before the revenue is converted, the value received in domestic terms is reduced. An investor who holds foreign securities faces the possibility that their returns will be diminished by an unfavorable exchange rate movement. Three principal types of currency risk are recognized. Transaction risk arises from specific identified future cash flows in a foreign currency. Translation risk arises when the financial statements of foreign subsidiaries must be converted into the parent company's reporting currency. Economic risk arises from the broader effect of exchange rate changes on a company's competitive position. Currency risk can be managed through hedging instruments and through natural hedges, matching revenues and costs in the same currency, or locating production close to the markets served. The risk cannot be entirely eliminated, but it can be understood, measured, and reduced to a level that is consistent with the organization's appetite for uncertainty. Currency swap. A currency swap is a financial agreement between two parties to exchange principal and interest payments in one currency for equivalent amounts in another currency, over a defined period. It is used to manage currency and interest rate exposure simultaneously. Imagine two companies, one based in the United States and one based in Europe, each with borrowing needs in the other's currency. The American company can borrow dollars cheaply. The European company can borrow euros cheaply. Each can lend what they can borrow inexpensively to the other, exchanging the flows of principal and interest over the life of the arrangement. Both benefit from accessing the currency they need at a cost reflecting the other's borrowing advantage. That is the logic of a currency swap. Currency swaps involve an initial exchange of principal amounts in the two currencies at the outset, regular exchanges of interest payments during the life of the swap, and a final exchange of principal at maturity, typically at the same exchange rate as the initial exchange. Currency swaps are used by corporations to access foreign currency financing at lower cost, by financial institutions to manage their own currency exposures, and by central banks to provide liquidity to their counterparts in other countries. Central bank currency swap lines, arrangements under which central banks agree to provide each other's currencies on demand, have been an important tool for managing global financial stress. A currency swap is a long-term instrument. Agreements may run for 5, 10, or even more years. Throughout that period, each exchange of payments occurs quietly and punctually, executing the terms of an arrangement that may have been negotiated long before any of the participants anticipated needing it. Current account. The current account is a component of a country's balance of payments that records the flow of goods, services, income, and current transfers between a country and the rest of the world over a specific period. It is one of the primary measures of a country's international economic position. Think of a very large account statement for an entire country. On one side, everything that flows in from abroad, receipts from the export of goods, payments received for services provided to foreign buyers, income earned on overseas investments, and transfers sent by nationals living abroad. On the other side, everything that flows out, payments for imported goods, expenditure on foreign services, income paid to foreign investors, and transfers sent overseas. The balance between these flows is the current account balance. A current account surplus indicates that a country is earning more from the rest of the world than it is spending. A deficit indicates the reverse: the country is spending more abroad than it is receiving. Large, sustained deficits can create vulnerabilities, particularly if they must be financed by capital inflows from overseas. The current account balance is closely watched by economists, policymakers, and financial markets. Persistent imbalances, particularly large deficits in major economies, can contribute to global financial instability and are often subject to international policy discussions. The current account is distinct from the capital account, which records international transactions involving financial assets. Together, the current account and the capital account comprise the full balance of payments, which, by definition, must balance. Every deficit in the current account is matched by a corresponding surplus in the capital and financial accounts. Current assets. Current assets are assets that are expected to be converted into cash or used within 1 year, or within the operating cycle of the business if that is longer. They represent the most liquid portion of a company's balance sheet. Think of everything in a business that is in motion: inventory moving towards sale, invoices awaiting payment, cash ready to be deployed. These are the assets that cycle through the business within a short and defined period. They arrive, they are used or converted, and they become cash. That ongoing circulation is what defines them as current. Common examples of current assets include cash and cash equivalents, marketable securities, accounts receivable, inventory, and prepaid expenses. Each of these is expected to generate a cash inflow or provide a near-term benefit within the coming year. Current assets are distinguished from non-current assets, also known as long-term assets, which include property, plant, equipment, and intangible assets that will remain in use for more than 1 year and are not expected to be converted to cash in the near term. Analysts examine current assets carefully when assessing a company's liquidity. The current ratio, current assets divided by current liabilities, indicates whether the company has sufficient short-term assets to meet its short-term obligations. A ratio below 1 suggests potential liquidity risk. A ratio significantly above 1 may suggest that the company is holding too much in liquid assets that are not being put to productive use. The balance between liquidity and efficiency is one of the ongoing questions of working capital management. Current liabilities. Current liabilities are obligations that a company expects to settle within 1 year or within its normal operating cycle. They represent the short-term financial claims on the company's resources and are listed on the balance sheet alongside current assets. Picture the outgoing side of a business's short-term financial position. Invoices that must be paid to suppliers within 30 or 60 days. Wages due at the end of the month. The current portion of long-term loan repayments falling due in the coming year. Tax obligations accrued and due. Each of these is a current liability, a commitment that must be met from the company's current resources within a short period of time. Common examples of current liabilities include accounts payable, accrued expenses, short-term debt, the current portion of long-term debt, customer deposits, and deferred revenue. Each represents money owed or an obligation due in the near term. The relationship between current assets and current liabilities is central to the assessment of a company's short-term financial health. Working capital, the difference between current assets and current liabilities, indicates the buffer of liquid resources available after all short-term obligations are considered. Positive working capital suggests the company can meet its near-term obligations. Negative working capital may indicate liquidity stress. Current liabilities change continuously as invoices are received and paid, loans mature, wages are earned and disbursed, and tax obligations accumulate. Managing them carefully is one of the fundamental routines of financial operations, not dramatic, not visible, but entirely necessary to the ongoing functioning of the enterprise. Current ratio. The current ratio is a liquidity measure that compares a company's current assets to its current liabilities. It is calculated by dividing total current assets by total current liabilities, and indicates whether the company has sufficient short-term assets to cover its short-term obligations. Think of two columns placed side by side. On the left, the total value of everything the company expects to convert to cash within the year. On the right, the total of everything the company owes and expects to pay within the same period. Dividing the left column by the right produces a single number, the current ratio. A ratio above 1 means the left column is larger. A ratio below 1 means the right column is larger. A current ratio of 2, for example, indicates that the company has twice as many current assets as current liabilities. This suggests a comfortable liquidity buffer. A ratio of 1 indicates that current assets exactly cover current liabilities, with no margin for error. A ratio below 1 suggests that the company may struggle to meet its short-term obligations from current resources alone. The appropriate level of the current ratio varies by industry. Businesses with predictable, fast-moving cash flows may operate effectively with a lower ratio. Businesses with slower cash conversion cycles or less predictable revenues may require a higher ratio to ensure they are not exposed to sudden liquidity pressure. The current ratio is a snapshot. It reflects the position at a single point in time. It does not capture the quality of the assets within it, nor the timing of inflows and outflows within the period. It is a useful starting point for analysis, but it is rarely the end of it. Custodial account. A custodial account is a financial account established by one person, the custodian, for the benefit of another, typically a minor. The custodian manages the account and its assets until the beneficiary reaches the age of majority, at which point full control of the account is transferred. Think of a trust placed by a parent or grandparent into the hands of a responsible manager. The manager, the custodian, does not own what is held. They simply look after it. They make investment decisions, manage the account, and ensure that the assets are preserved and grown for the benefit of the person in whose name the account was established. When that person reaches adulthood, the manager steps back. The account belongs to the beneficiary alone. Custodial accounts are commonly used as a vehicle for saving and investing on behalf of children. In the United States, accounts established under the Uniform Transfers to Minors Act or the Uniform Gifts to Minors Act are among the most common forms. They allow assets, including cash, securities, and other investments, to be transferred to a minor without the need for a formal trust. Once assets are transferred to a custodial account, they become the irrevocable property of the minor. The custodian cannot reclaim them. They must be used for the benefit of the beneficiary. Custodial accounts are straightforward in concept. The assets accumulate, the time passes, and at the appointed moment, typically when the beneficiary turns 18 or 21, depending on the jurisdiction, the account is handed over, complete with whatever it has become in the intervening years. Custodial fee. A custodial fee is a charge levied by a financial institution for holding and administering a client's securities or other assets. It compensates the custodian for the services provided in safeguarding assets, processing transactions, collecting income, and providing reporting. Think of a fee for the careful, ongoing maintenance of a safe. The safe holds valuables. The institution that maintains it provides security, administration, and accountability. In exchange for these services, a periodic charge is made. That charge is the custodial fee. Custodial fees are common in investment accounts, retirement accounts, brokerage accounts, and institutional investment arrangements. They may be charged as a flat annual fee, as a percentage of assets held, or as a per-transaction charge for specific services. The level of custodial fees has declined significantly in many markets over recent decades, as competition among providers has increased and technology has reduced the cost of administration. Many retail investment platforms now offer custody services at very low cost or at no explicit charge, recovering their costs through other means. For large institutional investors, pension funds, sovereign wealth funds, and insurance companies, custodial arrangements are more complex and more consequential. The custodian holds vast quantities of securities across many markets and currencies, processes large volumes of transactions, and provides detailed reporting that is essential to the management and oversight of the institution's portfolio. The custodial fee in these contexts reflects the scale and complexity of the service provided. It is a quiet but essential cost in the management of substantial wealth. Custodian. A custodian, in finance, is a financial institution, typically a bank or trust company, that holds and safeguards financial assets on behalf of investors. The custodian does not manage or make decisions about the assets. Its role is to hold them, administer them, and ensure their safekeeping. Think of a very large, very orderly vault. Within it, securities are held, shares, bonds, and other instruments belonging to many different clients. Each client's holdings are carefully segregated, recorded, and accounted for. The institution responsible for all of this, the holding, the record-keeping, the processing of dividends and interest, the settlement of trades, is the custodian. The custodian's responsibilities include the safekeeping of securities in physical or electronic form, the settlement of purchases and sales, the collection of income such as dividends and interest, the processing of corporate actions such as stock splits and mergers, and the provision of regular reporting to the investor. Custodians are distinct from investment managers. The investment manager decides what to buy and sell. The custodian holds what is bought. The separation of these functions provides an important layer of protection for investors. Assets cannot be misappropriated by an investment manager who does not also control their custody. Major global custodians include institutions such as BNY Mellon, State Street, and JP Morgan. They hold trillions of dollars in assets on behalf of clients across the world. Their work is conducted largely out of public sight, meticulous, continuous, and essential to the functioning of global financial markets. Cyclical stock. A cyclical stock is the share of a company whose business performance is closely tied to the broader economic cycle. These companies tend to perform well during periods of economic expansion and suffer during recessions, as demand for their products or services rises and falls with the general level of economic activity. Think of a tide. When the tide is high, the water reaches far up the shore. When the tide is low, it recedes. Cyclical stocks rise and fall with the tide of the economy. When conditions are good and consumers are spending, the companies that supply discretionary goods and services, cars, holidays, luxury items, construction materials, tend to prosper. When conditions deteriorate, demand for these products contracts sharply. Industries typically considered cyclical include automotive, housing and construction, travel and hospitality, luxury goods, and basic materials. These sectors share a common characteristic: the demand for their products is sensitive to changes in income and confidence. When people feel financially secure, they spend on these items. When they do not, they delay or forego these purchases. Cyclical stocks are contrasted with defensive stocks, shares of companies whose products or services are in demand regardless of economic conditions. Utilities, healthcare, and consumer staples are considered defensive sectors. They do not rise as sharply during expansions, but they tend to hold their value better during downturns. Investors who anticipate an economic recovery may increase their exposure to cyclical stocks to capture the expected upswing. Those who anticipate a slowdown may reduce it. The cyclical nature of these companies makes their timing sensitive, and their valuation dependent on where, in the long rotation of the economic cycle, we currently stand. Cyclical unemployment. Cyclical unemployment is the unemployment that results from a downturn in the economic cycle, specifically, from a reduction in the demand for goods and services that leads businesses to reduce their workforce. It rises during recessions and falls during periods of economic expansion. Think of the relationship between the economy and the workforce. When growth is strong and demand is high, businesses hire more workers to meet that demand. When growth slows and demand contracts, businesses need fewer workers. Some are laid off. Others find their hours reduced. The employment that disappears in this way, not because of structural changes in the economy or seasonal fluctuations, but because of a general slowing of economic activity, is cyclical unemployment. Cyclical unemployment is considered the most directly responsive to economic policy. Measures that stimulate demand, government spending, tax cuts, or reductions in interest rates, can increase the level of economic activity and reduce cyclical unemployment. This is one of the primary reasons that central banks and governments respond to recessions with expansionary policy. Cyclical unemployment is distinguished from other forms. Structural unemployment arises from a mismatch between the skills workers have and the skills the economy needs, changes in technology or industry that make certain jobs obsolete. Frictional unemployment arises from the time it takes workers to move between jobs, even in a healthy economy. Full employment, in economic terms, does not mean zero unemployment. It means unemployment that consists only of frictional and structural components, unemployment that exists in a well-functioning economy, without the additional burden of cyclical joblessness. The distance between where an economy stands and that benchmark is one of the measures of economic health that policymakers watch most carefully. And with that final definition, we close the ledger on the letter C. 150 words. 3 parts. The full breadth of C as finance understands it, from call options and capital, through credit and currency, all the way to cyclical unemployment. The alphabet of wealth is vast, but there is no need to master it all in one sitting. For now, let the terms we have discussed tonight, cost-benefit analysis and currency swaps, custodians and credit ratings, fade gently into the background of your mind. They will be there if you need them. They are not going anywhere. If you found peace in tonight's journey through the letter C, the library is always here for you, growing one quiet letter at a time. If you enjoyed this video, please consider liking and subscribing to the channel. It helps more than you might think. For other helpful financial resources, check the links in the description. Which word put you to sleep tonight? We would genuinely love to know. Leave it in the comments below. But for now, the business of the day is concluded. The markets are silent. The ledger is closed. Your mind is still, and your only remaining task is to rest. I am Simon Grant. Thank you for listening. Good night.